core PCE, as well as the PPI that we got earlier this week.
Robert Kaplan calling this a medium war in Foreign Affairs magazine. Has the Federal Reserve System ever dealt with a medium war? I don't think so.
What's changed for this committee? The last time they met that morning, crude was 62. Crude this afternoon is $30 higher. Plus, that's a big change for this committee to think about.
Do they say we are going to look through this? Are they going to say that typically oil price shocks are transitory, if you have to use that word, and that they will look through it and focus instead on weakness in the jobs market? Or are they going to say we are very concerned about inflation, we have remained above our target for too long, and we need to take action?
John, a headline here off of Bloomberg: Patrick Sykes in Istanbul, Dan Williams in Tel Aviv. U.S. aims to curb soaring oil prices. Is this more than we've ever seen? The central banker to the world.
What options do they have? We've seen escalation in the Middle East throughout today already. It looks like we have a new front for this war and its energy assets, and Iran is vowing to retaliate. That's where the pressure's coming from this afternoon for this committee, attempting to provide forecasts at 2 p.m. Eastern time. Good luck to them.
Really just get a dartboard, get some darts, and start throwing, because that's essentially as good as they could potentially get. In the meantime, we are seeing an escalation here with a focus not just on storage bins filling up, but actually some of the production facilities are actually being taken offline. Again, is this inflationary or is this deflationary down the line? Ultimately, economists can debate that. The Fed doesn't have that luxury based on the numbers they have right
So let's get the scores going into this one. We'll start with stocks. We'll go to commodities. We'll finish on bonds. The equity market this afternoon shaping up as follows, declining across the board on the S&P 500, down by 0.7%. On the NASDAQ, just off session lows, down by 0.7. Also in the commodity market, very close to 110 a little bit earlier on in the session. 108.40 right now, higher by close to 5%. And that sets the tone for this, the bond market. What a round trip this fixed income market has been on. 10s were down 30 basis points in February. Then all of a sudden, a round trip for the first few weeks of March.
Yeah, and whether we opine on where it's going to go matters less than who we have coming up shortly. JPMorgan's Bob Michael, Kathy Jones of Charles Schwab, and SocGen Subadra Rajappa. They will be taking us up to that Fed rate decision at 2 p.m. Eastern. Then we get immediate reaction from former Fed Vice Chair Rich Clarida, Stephanie Roth of Wolfe Research, and Diane Swonk of KPMG. And finally, breaking down Chair Powell's news conference, which he hopes to make as boring as possible, but I guarantee it will not be. Apollo's Torsten Slok and BlackRock's Jeff Rosenberg.
Does he do an 8-minute press conference? Is it going to be like when we were at Jackson Hole?
I said earlier on this morning, TK, I was like, look, it's Operation Epic Fury in the Middle East. It's Operation Make It Boring at 2:30 Eastern time.
If he doesn't say something in response to whether he's going to stay on, if he doesn't say something about whether this is inflationary or disinflationary, ultimately it will be news. You can't make non-boring boring.
Chris Condon in Washington says this is a big deal. Is that really a focus here?
I think
John?
It's got to be a focus. You have to ask the question directly, the chairman, where are you going to be after May? Is this your penultimate meeting? Is the next meeting your last one?
If you can't tell that, what exactly are you doing with forward guidance? How do you give forward guidance if you don't know the people in the seat, especially if there are dissents and the different people have very different views?
Bob Michael of JPMorgan Asset Management, charged with answering some questions. He joins us now. Bob, good afternoon. Good to see you.
Happy to be here.
Let's get to it. Three-part act: statement, projections, news conference. What are you expecting?
Well, first, I think this is the most mesmerizing FOMC meeting since COVID, and I mean that. The three things we're going to look at, as you laid them out, we're going to look at the post-meeting statement. We're going to see how the Federal Reserve characterizes the impact to risk on both sides of its mandate, full employment and price stability. They should say they're elevated. Secondly, you've got to go to the summary of economic projections and see how they reflect them in there. They can't just say, oh my goodness, we don't know, we can't do anything. They can't keep their head in the sand. Even if it's only decorative, they should raise PCE by a couple tenths, they should raise core by a tenth, and then also they should probably tilt unemployment higher by a tenth to reflect the elevated risk to both sides of their mandate. I think when you look at potential rate cuts, they should leave one rate cut in for this year and one rate cut for next year. The third part of this is the dissents. To us, that's the most critical thing. For sure, you can write in pen that Myron will dissent for a 25 basis point rate cut. But will Waller and or Bowman follow him? If they do, that tips the Fed's hand onto what they should be more worried about, the impact to price stability or the impact to the labor market.
What's the likelihood that with this two-sided risk, they introduce or reintroduce the idea of rate hikes over the next 12 months?
I think pretty much zero. I don't see that probability, and I know there's a tremendous amount of conversation on the ECB, for example, that they're a single mandate policy, price stability, so they should be hiking rates. But let's not forget, even there, Christine Lagarde is the chair of the ECB. She was the finance minister of France back in 2008. And after the ECB hiked rates in 2008, she came out very publicly to criticize it, as did President Sarkozy. So I think central banks have learned from 2008 and also the ECB from 2011 that when you have this sort of geopolitical orthogonal shock to the system, it's going to tighten financial conditions somewhere. You don't pile on by hiking rates unless you see it passing through to core prices and then ultimately to wages. We're a long way away from that. I don't think they'll open that can of worms.
Let's avoid right now the 5-year, 7-year, 10-year certitude of private credit. Let's go the other way to the short-term market. What does JPMorgan see in the plumbing of our financial system into this meeting?
Well, there's the bank lenders and the non-bank lenders. And the bank lenders are heavily regulated. The public markets are heavily regulated. The non-bank lenders, not so much. I think that's where you've seen some of the volatility in the private credit markets. And of course, there is that concern when you see that kind of volatility and when you see a lot of holders try to head for the exit. But the system seems to be working. There are 5% redemption clauses. Those are being exercised. That's fine. I think the big concern to everyone in the markets is private credit hasn't been through a shakeout yet. It's been chugging along for the last 15, 18 years. It's post-GFC. Recessions create the ultimate shakeout.
John, do we agree that if we didn't have a war, private credit would be the #1 topic
Without
of
a doubt. Lisa's been talking about the same thing. I'd say that. I'd say AI disruption. And those two issues are still percolating. It's the accumulation of risk, I think, over the last 2 months, Bob, that gets everybody's attention. Is that a headwind to this market?
Do you know what's so funny is I pulled up financial indicators, financial condition indicators. You pull up Bloomberg's, it's gone nowhere. You look at market pricing, it's gone nowhere. I think that's a question for Jay Powell. How do they interpret financial conditions indicators? Is there a sense of complacency across the market? Yeah, there are all these concerns out there, but perhaps there's so much liquidity in the system, it just overwhelms the concerns for now.
We've certainly repriced energy. You've seen that in the price of crude across the futures curve. We've repriced interest rates. You've seen that at the Federal Reserve and the ECB looking out 12 months. What's curious to me is the extent to which we haven't repriced economic growth for this economy and for elsewhere.
Stagflation is a terrible recipe. It's a terrible recipe for growth. And if you have an increase in oil prices that go beyond this current level that you see, you start to wonder when credit's going to pick up on that, beyond just the disruption. If you add to that some sort of shock that will potentially suppress growth.
We're super lucky that capital markets are still wide open.
Correct.
We've talked about this a million times. Markets can shape the events they anticipate. The fact that we've still got credit spreads that are still pretty tight. The fact that this month alone, we had the biggest single day of US IG supply, and it was met with tremendous demand, is good news. Whether you think it's complacent or not, it could be a whole lot worse if those things weren't happening.
And it raises the specter of how fragile they are. And that's really, I think, what people are gauging. Is there something the Fed Chair Jay Powell could say that could potentially disrupt that complacency or that openness that we're seeing in capital markets?
Do you want to announce a Mag 7 bond offering on the show today?
Do you want some 100-year alphabet?
Yeah,
Can we pitch some 100-year alphabet?
You know what? We work with these companies when the issue. The reality is they see a lot of demand out there, and they've got to build the capacity to get that demand monetized. So it's real for now.
Is this a sales call? I think
it's good to see you, Bob. You're going to be sticking with us, I'm pleased to say. Bob Michele of JPMorgan. Up next on the programme, we'll catch up with Kathy Jones of Charles Schwab, Subadra Rajappa of SocGen. That conversation just around the corner. Heading into this, a Fed decision just moments away.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
I believe that talent is equally distributed, but opportunity isn't. But education can give everybody the opportunities that they deserve to fulfil their potential. That's why I got involved in politics and why I got involved in the Labour Party.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, Tuesdays only on Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism. This week, the Fed's reaction to the Iran war with Randy Quarles, former Fed vice chair, how Australia's attempt to limit social media for young people is working out, and a different view on AI. What if, after all, it's simply a normal technology and not the revolution some predict?
Let's look at reliability separately from capability. Capability is not enough.
Watch Wall Street Week. More than what you need to know, it's what you need to think about.
We're in the fog of war. I think the Fed's in the fog of war as well.
The pressure's there, right? It could complicate from an inflation picture.
We have the greater risk of a stagflationary scenario, and that is problematic for the Fed.
There's much more concern about the stagflation risk.
That now puts them in a very, very difficult position.
Not just inflation shock.
That this is creating a bit of a growth shock.
The Fed is going to be cautious.
I think the Federal Reserve should just stay on hold here.
On hold here.
It is on hold.
On hold.
On hold.
Wait and see. We hear wait, careful. We hear a lot of words like that.
It's a wait and see game.
I don't think that the Fed will be as dovish as they have been.
So I wish they just, not be hawkish or dovish, but be honest.
When oil prices go up, headline inflation goes up.
The big piece of this is how long this energy shock lasts.
The Fed will have to increasingly acknowledge the two-sided risks from this.
This divided Fed is going to look even more divided.
Certainly the politics are swirling around.
Their motto for the March meeting should be one battle after another.
Live from New York City this afternoon. Good afternoon, good afternoon. That Fed decision, 15 minutes away. The scores into it look like this. Equities declining by 0.7% on the S&P 500, down by 0.6 on the NASDAQ, sending a tone for financial markets worldwide. These moves in the commodity market, Brent and WTI, a major rally over the past few weeks, just short of 110 on Brent and up by close to 4% on the session, and a big move at the front and long end of the curve over the past few weeks. Twos around 370, tens still through 420.
Right now, Fed funds futures have priced out a full rate cut for the remainder of 2026 as they see some of the increases in inflation. Does the Fed now lean into that and then confirm that and say, look, we don't plan on making a move?
Let's get to Kathy Jones at Charles Schwab. Kathy, welcome to the program. We've had the energy shock. Now the Federal Reserve needs to provide some forecasts. What does this mean for inflation, for growth, and ultimately, what does it mean for policy? What are you expecting?
Well, I think there'll be a lot of confusion. I'm not really taking the SEP or the dots very seriously this time around because I have to be like throwing darts right now. Given that we don't know how long this lasts, it's already lasted longer than the consensus, and therefore, when they're making these forecasts, I think it's just really a guess on the part of the various members. If you remember during COVID, they actually suspended the dots because of the uncertainty. I don't think they'll do it this time around, but I think it would be really, really difficult for anybody to pin down a really precise estimate. But I'm going to be interested anyway to see the dispersion of the dots, to see what they do with their estimates. I'm assuming the estimate for inflation goes up and estimate for unemployment goes up just to reflect reality on the ground. But in terms of what the Fed really probably is concerned about right now is inflation expectations. So when I'm looking at those break evens in the TIPS market, they're just continue to move up and move up, and they've really focused on inflation expectations many times in the past. So I think that may be a real concern for them as they look towards setting policy down the road.
Do you agree with Bob Michele, who just said that this is probably the most interesting Fed meeting since the pandemic era, where they had to decide what to do and when they did suspend those dots?
Yeah, I agree with Bob. It's just very difficult situation for any investor and certainly for the Fed. How do you make a forecast when every 12 hours something new happens, right? But I will say, having maybe experienced oil shocks in my past, I think the one thing that probably the Fed that will resonate with the Powell and other members of the Fed is they don't want to make the mistakes that were made in the past, even if it's a bit different today. And there's differences in supply. The 1970s were, a disaster because the Fed was too late to address the inflation coming from the oil price shock. So I think that that's a mistake they really want to avoid.
Bob, with this uncertainty, I mean, you're the only one I know who read the 1,100 pages of Fibozzi. Are the dynamics of the full faith and credit bond market working right now? Describe what your pros see, the nuances of the bond market, given this new uncertainty.
I think they are. And I know we can sit here and say, over this period of time, rates have risen 30 basis points. But I look at them and I come on, 370 on the 2-year. The Fed funds rate is 3 5/8. That's flat to the Fed funds rates. That's where it's supposed to be. A little steepness out to the 10-year. This is all within sort of the range that it's been in. What we're hearing from clients is they're looking for an opportunity to get into the bond market. They feel underallocated to it. They sense there's a little bit of a backup here. Is this the time to get in, and where do they get in? I also want to remind people that the Fed went into this Iran war concerned about the labor market. It was no hire, no fire, for good reason. Businesses didn't know what the shape of tariffs would look like, and everyone was concerned about AI. You didn't want to hire somebody today. You might have to fire 18 months from now. Now you pile on top of that, businesses and households are facing attacks from higher energy prices. So businesses for sure don't feel like doing any hiring now. I think they're going into this meeting even more concerned about the labor market than the pass-through of this orthogonal oil shock.
How many times have we heard that this week, that all roads lead to buying bonds? That if the shock continues in the Middle East, buy bonds, it's going to hit growth. If it goes away, buy bonds, yields are backed up too much. Just buy bonds seems to be the conclusion.
Well, I know one bank CEO who would take the other side of that. And I heard that yesterday.
Well, I will say the counter argument to that is if the Fed actually is overly dovish, do you start to see a huge sell-off and an increasing possibility of there being a 1970s style shock where wage growth follows some of the increases that we're seeing in commodity prices?
So, Kathy, let's come to you on that. The assessment of second-order effects, the potential for pass-through to core good prices, pass-through to other prices in the economy.
Yeah, I think it's a real risk to the economy that we're going to see some pass-through. Consumer demand has been resilient despite all the problems that we're having, say, in the labor market and elsewhere. And if that continues, then the ability to pass through the price increases will be there. I do think that is, again, a risk that the Fed has to deal with. Even if the labor market weakens from here, how much weight do they put on that if we're seeing core goods prices continue to go up? And they have been above the Fed's target for now, 4 years? And not making any progress towards their target. So it's really a difficult position for them to be in. Yes, if the unemployment rate really starts to ramp up, then that means demand destruction. That means the Fed will ease. But until I think that dynamic starts to happen, the focus is going to be on trying to contain the inflation pressure passing through from oil prices.
Kathy, just a final question for you. The Fed chair, his last scheduled meeting should be April 29th. Do you think he's going to be there June 17th?
It's looking more likely all the time. Can't handicap it real well, but it's looking more likely all the time.
I can tell you, break exclusive, is that what you call it, TK? Break exclusive?
Yes.
Kathy won't be there. Kathy won't be there because Kathy is retiring. Kathy, can I just say on behalf of us all, thank you so much for your contribution to this programme over the years and how lucky we've been to catch up with you every single Fed meeting. Kathy, before you go, a word of wisdom on fixed income. What's the biggest lesson in your career? What could you pass on to a new generation?
Oh, I think fixed income is wildly underappreciated and not well understood by most investors. I would say, do your homework. It's a great place to invest.
Is that shade on Liz Ann Saunders?
No,
absolutely not.
Every fixed income pro, even when they're exiting, throw some shade at equity strategies.
They do.
Every single time.
Well, it's a smarter asset class, so there we are,
Hey.
Swan song.
Kathy's a class act. Wishing you the best in retirement,
Absolutely.
Kathy.
Hear, hear.
Thank you. And thank you to all of you at Bloomberg for having me on so many times. It's really been a great honor. You always make everybody feel comfortable and able to speak freely. So I really have appreciated it.
Kathy, we're the lucky ones. Thank you so much. Best of luck. Kathy Jones there of Charles Schwab. Bob, throw me shade at equity guys all the time, right? It's just a fixed income religion.
Well, I'm backing off of them now. I know they're down there
you're kind to them.
They're down there at the bottom of the capital structure, absorbing all of this volatility. You have to have some sympathy for the junior securities guys.
There you go. Nothing changes, right? Nothing changes. Subadra Rajappa of SocGen joins us now. Subadra, welcome to the show. Decision about 6 minutes away. What are you expecting to see at 2 p.m. Eastern Time?
I mean, congratulations to Kathy. I think it's fantastic. And I completely agree with her sentiment that people don't pay as much attention to the bond market as they should, because you get a lot of very, very useful signals in the bond market, including what you're seeing right now heading into the Fed meeting. I mean, the front end is starting to push higher. The market's pushing back on the possibility that the Fed will be able to cut this year. In fact, we're pricing in for no cuts for this year. And I also agree with Bob. I think that the market is, with the 10-year yields and 2-year yields, for the most part, within that range that we've had for the last 6 months, bonds are still the place where you want to put your money to work, because of the fact that even if the Fed doesn't hike rates, the front end of the yield curve is going to be pegged somewhat, I think investors are going to flock to the belly of the curve, given the fact that as the Fed stays on hold for longer, your risk is that they might have to cut more in the future, and that might impact growth. So to us, it feels like the belly is going to continue to outperform. As for the Fed meeting, I think I'm expecting this to be more of a placeholder meeting. I'd probably expect more of a bearish bias, or a hawkish bias, I should say, for the Fed. And the changes to the summary of economic projections are going to be quite interesting. I'm expecting them to push up their expectations for headline and core inflation, and perhaps bring down their expectations for growth for this year.
Subadra, have we seen the peak in the yield curve so far? We've seen now the 2-10 spread now at the tightest going back to November of last year, as people price in the Fed remaining on hold for longer and lower long-term growth projections. Is that trend going to continue?
I think that the 2-10 curve does look very flat. I don't really see the prospects for the Fed switching from an easing bias to a tightening or a hiking bias, just like what we're seeing perhaps with the ECB and other global central banks. I think that the Fed stays on hold for longer at best, and that should keep the 2-year yield somewhat within the current range, or slightly higher perhaps. Unless we shift towards a hike, I don't see 2-year yields really starting to rise. But that said, I think that, like I was saying earlier, I think the growth prospects and the potential for a meaningful slowdown in growth next year would mean that the yield curve is going to have to remain somewhat flat. So the investors are going to continue to buy the belly.
Subadra, communication is key. And in this news conference, the chairman is bound to be asked about its future. If he commits to staying on, because Kevin Walsh won't have time to be confirmed, in your mind, I'm interested in your individual perspective on this, your judgment as a market participant. Does staying on provide consistency or invite controversy?
I think it definitely provides consistency. What the market's looking for is a steady hand from the Fed and the committee at large. I mean, what we don't want to see is kind of a temporary Fed coming in and not knowing what the direction of policy is going to be. So to me, I think the best way to transition would be from Powell to the next Fed chair, in an orderly fashion, as opposed to having somebody interim and then having to switch back to Powell. So that's kind of what I'm hoping for.
Subadra, good to see you. Thank you. Subadra Rajappa there of SocGen. Bob, just to turn to you, same question. Do you agree with that?
I think him staying on creates stability. Personally, I believe he'll stay on past the midterm elections.
Past the midterms?
Past the midterm elections.
Why will he stay on?
Because He'll want to ensure that the market sees the independence of the Fed, that he's already been there for 14 years. He's a stabilizing force, and they can't be politically influenced.
Will he stay on as Fed chair or as governor or both?
I think after the midterms, he will no longer be Fed chair, but I think at the May meeting and perhaps the July meeting, he will be still the Fed chair. It all comes down to what Tom Tillis decides, what the courts decide on Lisa Cook and the suit against Jay Powell. All of that resides with Tom Tillis.
This show used to be simple.
Right? It's got complicated, hasn't it?
It's just unreal.
The Fed's got complicated. Neil Datta of Renmag writing in, Walsh, no matter what, will walk into the Eccles building as the weakest Fed chair in recent memory. He's limping in. The opinion of Neil Datta just moments ago.
In part because of skepticism by the market, but also in part because this is just a difficult economic time. There isn't a consensus to be had on exactly how you grapple with stagflation.
This is not a small matter on real and also nominal GDP and all the distractions we've got now. Now I want to talk to Clarida about that when he shows up. But to me, the weaker economy is a really interesting trend.
We're 60 seconds away from a decision, and a lot of people in this market will be looking for dissent. A dissent from some governors, in particular, who are worried about the labour market. And on the same committee, the very same committee at the very same meeting, there's a collection of officials on this committee who are worried about overshooting the inflation target for the past 5 years. That's how divided that committee is right now.
How do you deal with a paradigm shift with an oil shock thrown in, where you have AI creating real questions about productivity at the same time that you do have inflation, but you also have the potential for more efficiency?
Crude has gone from in the 60s when the Fed last met, the morning of the last Fed meeting at the end of January, to in the 90s, off the back of a shock in the Middle East and a major rally over the past 2 weeks plus. The scores heading into this decision look like this. Equity markets this afternoon on the S&P declining by 0.6% in the bond market. We're looking at 2s, 10s and 30s shaping up as follows. Yields on a 2-year at 3.71. With that Fed decision, here's Mike McKee.
No change in rates, no change in dots, one dissent, but some big changes in inflation expectations. Fed officials see one cut still in 2006 at some point, even though their statement notes that uncertainty about the economic outlook remains elevated. 3 members who favored no cuts in this year moved their dots down to 1. The statement goes on to say, the implication of developments in the Middle East for the U.S. economy are uncertain, and the committee remains attentive to risks to both sides of their mandate. They still see one more cut in 2027. Stephen Myron, the only dissenter, he wanted a 1/4 point cut this time, and from the dots, we discern that he still wants 100 basis points at some point this year. The language about future moves remains the same. They still talk about the extent and timing of additional adjustments to the target range. It's the summary of economic projections in which we see a lot of changes. PCE inflation this year is forecast at 2.7%, up from 2.4% in December. Core is also seen at 2.7%, up from 2.5%. Both drop to 2.2% next year, up from 2.4% in the December SEP. Core is seen at 2.7% this year. Both drop back, as I mentioned, next year to 2% in 2028. GDP marked up 1/10 in both years, both of the next 2 years, to 2.4% this year and 2.3% next year. The unemployment forecast remains 4.4% in 2026, dropping to 4.3% next year. That's up from 4.2% in December. And the longer run estimate for Fed funds, seen as the proxy for the neutral rate, rises a tick to 3.1%. Guys?
Mike McKee, thank you, sir. We'll catch up with you a little bit later. Let's start with the price action. We'll go equities, then bonds. We'll have a sneak peek of what's happening in the commodity market because we're tracking that throughout the day here at Bloomberg. Equity markets, looking at the S&P 500, off session lows, but still negative by 0.5%. In the bond market, yields slightly higher on a 2-year by 2 basis points, basically as you were at 370 on 2s, on 10s at about 421, which is basically where we were going into this decision. So this is what we're doing. You go into the projections. We'll ignore the statement just for a while. We'll go into the statement and we'll look at the projections and compare what they were projecting back in December and have a look at what they're projecting now. So let's just go through 2026 for GDP, revised slightly higher. That's some good news. 27 as well. Same thing, by the way. So they revised GDP higher, they revised inflation higher, and they've kept the projection, the implied projection for interest rates exactly where it was for December. Those kind of moves should be music to the ears of bullish market participants.
This is an incredibly dovish hold, just by virtue of the fact that only one person dissented, and it was Governor Myron. That alone. But these projections highlighting a tolerance for higher inflation and still the belief that it will come down by 2027 to that 2% level without hiking rates and continuing with rate cuts gives you a sense of where this Fed's mind is at. This seems like more of a consensus than I expected, than a lot of people expected, and it is more to looking through any kind of oil price shock.
In honor of Alan Greenspan's 100th birthday, it was a Greenspan decision. Everybody got on board with the chairman. That's all there is to it.
And the out years, the good news on the inflation front, you decide whether this is good. The Fed is still basically forecasting the same inflation glide path as they were before, even with this lift to 2026.
How do you say transitory without saying transitory?
Right? It's in there in the forecast.
And that's the reason why you're seeing the yield curve steepen. And on the margins, you're seeing 10-year yields higher on this, because ultimately this is a Fed that is willing to stay on hold and look through an oil price shock, look through the fact that even core PCE has been higher than expected and is expected to stay that way, because ultimately they do think the labor market is showing signs of cracks, even though they don't necessarily see unemployment rate ticking up. And they do want to err on the side of being more accommodative.
One official I'd like to speak to, just briefly, get him on the phone. Governor Waller.
I was about to say, Chris.
Okay, no dissent. He said it was a coin flip. It would come down to the labour market report, and that labour market report was overwhelmingly soft. So what does he see in the outlook for inflation that's kept him on the sidelines?
Governor Waller, please join us. If you want to call in, we'll take you. I mean, ultimately, that is one of the key players, because he is a pillar of the swing vote, if you will. And a lot of people are looking to him for some sort of guidance about what exactly is driving his decision.
But at Washington State, he was expert on game theory. And when there's a war, there's a different game theory.
This is a major shock we're working through. Bob Michele at JPMorgan Asset Management still with us around the table. Bob, your early thoughts off the back of this one?
I do. They're telling us, don't worry about it. There's a little bit of a near-term inflation shock. They added a tenth more than we did, but it's fine. The economy is going to use that to accelerate. So they increased GDP. That I don't get. And they left unemployment where it is. And it also doesn't sync with the dots. I heard Mike McKee say that 3 members who previously voted for no cut changed their view, and went to a cut.
The median dot 3.4, December projection, the median dot 3.4. Joining us now to discuss is the former Fed Vice Chair, Richard Clarida. Now, Rich, I know the word transitory is banned and they can't use it anymore, particularly in the news conference, but does this scream transitory?
Well, it certainly screams we need a synonym for it. Temporary, not long-lived. You know, they could justify it perhaps by looking at the oil futures, which still show this as dissipating over time. But the short answer is nobody, including the Fed, knows. This is very elevated geopolitical risk, and there are risks on both sides. But the baseline, I agree with your panel, is dovish constructive.
Rich, I'm just wondering how much this is just AI written all over it, how much this is a Fed that is basing their entire assumption on a productivity boom tied to artificial intelligence and the deployment of it through the economy, and frankly, disinflation on its heels.
I think there's an element of that, perhaps more so with the incoming chair than some other members. I think it's also a statement, however, that AI is a support to demand in the economy that to some extent, along with those big, beautiful bill tax cuts, is probably going to offset some of what the drag would be from the oil price increases. But again, this is a modal or a baseline, and I think certainly internally we'll hear that there was a discussion of the risk cases as well.
Professor Clarida, when you were at Columbia herding cats, Xavier Sala Martin taught the acclaimed principles of economics. Talk to us about the risk of a demand destruction here. To me, it's extraordinary, whether it's war, short-term, or a more permanent demand destruction. Should that be a legitimate concern of the Fed?
Well, the demand destruction comes simply from the fact that not only oil prices, but energy prices and goods that are intensive in oil and energy will go up, and that will tend to reduce the real incomes for millions and tens of millions of households. Now, on the other side of that, you have the AI boom, but there is no doubt that this is going to squeeze real aggregate demand the longer the oil shock persists.
Check out the price action. Let's go to equities. We're still down by 0.6%, unmoved by what on the surface of things looks like a dovish decision from the central bank. Check out the bond market, similar story, no big moves off the back of this. The only takeaway, this can change, but the only takeaway for me is there is nothing this institution can do to drive this market in the face of the shock elsewhere. Jeff Curry of Carlyle said it really well earlier this morning on Bloomberg TV, when Jeff turned around and said there's nothing the central bank can do about this, you cannot print barrels. This market is still at the mercy of what happens in the commodity market, and the Fed is not the circuit breaker anymore, because this Fed decision, I would sit here and argue, is fairly dovish, with the exception of the absence of a dissent coming from Governor Waller, is fairly dovish. To come out and say the outlook for growth is better, we've revised higher the outlook for inflation, and the median dot is exactly the same, screams dovish, and yet here we are. No big moves in financial markets. I think that's notable.
The Fed is playing dodgeball without the ball. They're not the pitcher in a game. And right now, what they're dealing with is shock after shock without necessarily historic precedent. Yes, there are historic precedents for oil shocks, but not for the AI shock and what that does to the overall economy. So they might remain on hold, and that might be bullish, but not in this moment, because right now, if another oil or natural gas plant gets bombed, people are going to be watching that much more than anything coming out of Jay Powell.
You know, Vice Chairman Clarida, the thing I would point out here, and Damian Sassower at Bloomberg is very cautious on EM suddenly here. In this meeting and in this press conference, more than ever, is this the central banker to the world?
Well, sure it is, and I think that the Fed is aware of that. And I think one thing this episode is reminding folks, we've seen it in the dollar, obviously, is since the Iran hostilities commenced, the price of gold is down, the price of the dollar is up. So I think there is that element as well. But broadly, the Fed is reacting to events. I think Lisa said it well. First and foremost, this is a major geopolitical and economic shock. The dodgeball analogy, I think, is a good one. So I think, yes, the Fed is the central banker to the world, but it's not the main attraction right now.
Bob Michael with us with JPMorgan as well. What is with the tentacles of JPMorgan around the world? How is EM doing? I see Philippine peso almost out to 60. You saw Australia raising rates in
whoa. We're calling Australia EM.
No, I'm not calling Australia EM.
Get you in trouble, TK.
No, I'm not calling. I'm watching Aussie yen, though, which is a life of its own.
Sydney watching.
What's the Swissy
Their early morning. Deeply unhappy with that.
But I read all the Neville Shute, including Town Like Alice. I want to know, as a central banker to the world, the sensitivities he faces. What does JPMorgan see on the reaction in the currency markets, the reaction in fixed income of EM as the chairman speaks?
I think there are a couple things. One, we felt going through this that the dollar would be the safe haven bid. And we're seeing a lot of that. We also felt for those who wanted to diversify away from dollar, emerging market FX was the place to go. The central banks in those regions seem to be on top of things. Yeah. And you had a split between those who are energy importers and those are energy exporters, those that are sitting on rare earth minerals and other minerals, and those who aren't. And I think we're seeing all of that play out. But I will tell you, our client base still feels underallocated to emerging markets, both equity and fixed income. We're seeing those allocations continue to come in. I think there's a good tailwind there.
He just went along Australia.
There you go. Back-to-back hikes at the emerging markets central bank over the RBA. See that? Honestly, there's some offended people down under right now.
I'm not weighing in on this one. But I will say that tomorrow will be really interesting with the BOE and the ECB.
There you go. You tell them, Bramo.
All right.
Rich Cloud still with us. Rich, I want to come to you on an important topic to wrap things up, a really serious one. The future for Chairman Powell. This is not how usually these things play out. Typically, how this plays out, the chairman knows when his term finishes, he gets a great send-off, he walks away, and he does a $1 million speech in about 12 months' time and has a happy retirement. This feels so different, Rich. Kevin Warsh is ultimately being nominated. We have no idea when the confirmation hearing is going to be. Bob Michael sat here a little bit earlier and said he thinks the chairman, Jay Powell, is still going to be there by the time you get to the midterms. Rich, how do you think this process is going to play out in the next several months?
Well, you're absolutely correct. This is unprecedented, unusual. That the handoff is usually pretty smooth and very well telegraphed. And the difference, of course, now is several fold. One, of course, is the the DOJ investigation of Powell that the Fed is pushing back on. In addition, of course, even Warsh getting a hearing is now up in the air. I certainly do expect Jay Powell will stay on. And perhaps a meeting or two after Warsh finally arrives. Whether or not that's after the midterms, I'm not sure. I think Jay Powell will move on once Warsh is in place to his future life. But his real focus is on maintaining the independence of the institution. And I think he will be in place until Warsh is confirmed, and perhaps a meeting or two thereafter.
Rich, appreciate your insight on the topic. Thank you, sir. Rich Clarida there, the former Fed Vice Chair on this Fed decision and the Chairman's future. If you are just joining us on the programme, welcome to the show. So unchanged, the policy rate of the Federal Reserve about 15 minutes ago. Some dissent, the vote 11-1. That dissent came from an obvious place. Governor Myron voting for an interest rate reduction for the projections. Big focus on what was happening with inflation. They've lifted their outlook for inflation for this year, at least, but left the median dot ultimately unchanged, implying one rate cut from this Federal Reserve for 2026.
To me, the most interesting takeaway is what you said, which is this market doesn't seem to care, even though this is very much a dovish hold. This actually is news in Fedland, and yet the market doesn't pay attention because there's another game in town, and it's everything else in the world. And some people might say, oh no, the adults can't control this. They can't step in and save us. And the other people will say, we haven't had a free market in a long time, and this is what it looks like. And guess what? It's a welcome exercise. And so those two sides of the debate are playing out in markets today.
You think we've got a free market?
Well, I mean, that's the whole thing. Ultimately,
don't get too excited.
Well, I'm kind of excited about this. I mean, that's kind of a nice thing, not to have the thumb on the scale all the time and the same story over and over again.
It's a change.
All right.
It's a change.
I'll get off
Stephanie Roth of Wolf Research, I can see how excited you are. You're not alone. I've been waiting for that moment for a long, long time. Major moves, 5% away from all-time highs.
Even the Japanese market, it's now exciting. Who knew?
They're actually trading the benchmark in Japan now.
There's actually traders.
Stephanie, I'm sorry. Stephanie Roth of Wolf Research joins us now for more. Stephanie, we need your reaction to the decision and where you expect the emphasis to be in this news conference.
Yeah, I mean, the emphasis is going to be on the reaction function, provided that energy prices end up staying longer. The question is, are they going to end up looking through this, or do they ultimately end up having to be dovish as a result because growth will end up slowing? And our own view is that because the economy is so different today versus 2022, they'll ultimately have to be more dovish as a result of the war in Iran rather than the opposite. Otherwise, it tells you a story of productivity and that growth is actually going to be higher in the future years, but then, nothing else changes. And the one thing that we didn't talk about, or that wasn't talked about yet, was the longer run dot shifting up a little bit.
Well, this to me, Stephanie, that I'm really wondering about is how much does a more dovish Fed enable something that looks more like 1970s or more like 2022 and what we saw with inflation and the read-through? Is that something of a concern for you?
No, because the backdrop is so different today versus, say, 2022. If you look at 2022, the unemployment rate was 3.7 heading to 3.5. Today it's 4.4. Payroll gains was growing at 600,000. Today they're somewhere between 0 and 50,000 on average. The inflation backdrop was different. Core inflation was 5.5. Today it's 3. So the idea that we're going to have a repeat of 2022 seems like a very low likelihood event, and therefore that's not something I would expect the Fed to react in that way because the data probably won't support a reflationary type of environment.
Stephanie, given a war, given what oil's doing, John mentions it's 60 to 100 or even higher, we're still slaves to the job market. And the answer is the unemployment rate hasn't broken. With the war, with the distractions, how ex post is this Fed into the summer?
Yeah, I mean, I think they're going to be in an environment over the summer where base case is the unemployment rate is probably steady, but they're going to be looking at this most closely. That's going to be the deciding factor between whether they are able to cut, probably not at Warsh's first meeting, maybe in September or December. Right. And it's going to all come down to the unemployment rate. Is it notably above 4.5, in which case they have a window to be able to ease? And if not, then it's going to be tough or worse to get the rest of the members on board.
Bob, synthesize Michael Feroli's work on this then. The fact is the labor market hasn't crashed yet. They have to wait, don't they?
I think that's part of it. I'm still gobsmacked by the Fed's decision. They're basically saying all of this going on in the Middle East is a speed bump. That, yeah, inflation will tick up, you know, 0.3 and 0.2 here and there, but the economy will accelerate, unemployment will stay stable, and it's off to the races. I just don't see that. I think there is a real impact to inflation and then ultimately to the economy and the labor market.
This is the heart of the matter, John. This is the absolute heart of the matter, and everybody has to recalibrate their x-axis to how long is this going to go on, and then you get to demand destruction.
We mentioned this earlier, and I think it's important to keep going over it. We've repriced a lot in this market. We've repriced energy, had a big move from the 60s out to triple digits. We've repriced interest rates. We've taken out a lot of easing for the Federal Reserve, and we've priced in hikes in places like the ECB, 2 of them, I think, for this year now. Yet we haven't repriced growth, and the Fed hasn't either. And I'm not just talking about where spot is trading or the front month on the futures curve. If you go out to December and look at where December is traded right now, we're close to 80. So we've gone from the 60s to close to 80s on the December contract, and the Federal Reserve has lifted the outlook for growth. What's driving that?
I wonder how much momentum they think is in the economy, how much AI and data center spending is going on. Were they surprised by the Delta earnings and that, you know, sales are at a high despite higher energy prices? I think the reality is when you've had close to a 50% hike in energy prices, it's a tax on businesses and households, and they will respond by cutting back some of their consumption.
We have the smartest viewers, and I just want to point that out.
Sure.
One of the viewers just wrote in. We do.
Oh,
and pointed out that among the members, the actual dots might say one thing, but the risk to GDP downside included 14 members versus 8 prior at the December meeting. The risk to the upside was 16 members for core PCE, as well as the unemployment rate. That was up from 12 and 13 members, respectively. So that stagflationary outcome still in the back minds of so many of these Fed members. They just aren't making this their base case. So I don't understand, Bob, and I guess that this is my question. Is the reaction function essentially they will hold pat even in this scenario? Or do you have a sense of what the reaction function is to true stagflation?
Well, the bottom line is the market is just looking through the Fed right here and saying, doesn't make sense, don't get it, don't know what they were thinking. The projections don't make sense to me, but I know where we are. There's a lot of tension still in the Middle East. It's yet to completely play out. I think where we are now is about fair. It can go either way from here. So it's completely dismissive of the FOMC statement.
Hey, Stephanie, before you go, what's the number one question for Chairman Powell into this news conference?
Yeah, I mean, the biggest question is going to be, provided energy prices are elevated through much of the summer, how are you going to think about the balance of risk? Is this going to be something that you're going to, look through, and do you expect that growth is going to be lower as a result? Or is this something that you're worried about, more similar to 2022? And what are the balance of risks in your mind in terms of how this could play out?
Stephanie, good to see you. As always, thanks for jumping on. Stephanie Roth there of Wolfe Research. To build on the conversation, Diane Swonk of KPMG. Diane, I'm going to use a quote of yours to ask you the question. A dual mandate or a dueling mandate? What have we got?
A dueling mandate, and I think that's a real problem. I think the Fed is this dovish sort of numbers don't add up. I think I agree with that completely. A dovish pause is not what I would expect. I would have expected some people to actually put in rate hikes in this meeting, and they didn't. And I think there's a real issue about, we saw rate cuts in late 2024 to shore up the labor market. We didn't get any jobs. We saw rate cuts in late 2025 to shore up the labor market. I don't think we're going to get a lot of jobs from those. That brings up the issue is the problem in the labor market more structural and systemic, something that rate cuts alone cannot cure and spur the demand for workers on? If that's the case, if you cut rates further, you're risking a more persistent bout of inflation, or worse, a stagflationary scenario. And I think the devil in the detail is in that stagflation scenario. Also important is that they raise their non-inflationary rate. That is reflecting, yes, productivity growth and the idea that the economy can grow more robustly without having without having inflation, but that also means higher non-inflationary rate, which is an important marker to put down before Kevin Warsh takes on as Fed chair, since he has argued that productivity growth should lower that non-inflationary rate. That is not what the Fed is saying. And I think that's very important. But I am very concerned about, we've 5 years in, we've got consumers expecting more inflation than they did in late 2024. And those expectations are going to rise, especially with salient prices like prices at the pump going up. And there's already a long tail due to the problems in the Middle East. Production idled is not easily brought back online. It's weeks to months, and we're rolling supply chains the world over. You create scarcities that go below the destruction in demand. That gives you stagflation.
Diane, is this the Fed meeting where forward guidance just died?
Absolutely. We didn't have a lot of forward guidance to begin with, but absolutely. And I think, what really will be interesting in the chairman's comments is what was the debate in terms of growth, what went into these numbers, how did the debate fall out. I think the devil in the details here is that there is a bit of a stagflationary concern out there, and there should be.
Diane, there's we suffer from 3 zip code scenario here in New York City. You've got a much greater national perspective. I take real issue with a narrow part of America being affected by $5 a gallon gas. How much of America is going to be flat on their back from some of these shocks?
Well, unfortunately or fortunately, we do have fiscal stimulus right now, and that fiscal stimulus will help absorb the shock instead of going into other kinds of spending, and that will help households. Tax refunds are showing up in consumer bank accounts right now, but the combination of fiscal stimulus with, remember, inflation is accelerating right now. We saw PCE accelerate. We saw the PPI numbers today. The translation of the PPI and the CPI for PCE for the month of February hotter, especially on core services. That's aside from what's going on in terms of tariff-based inflation. That is important right now, and I think that's getting lost in translation, but it does show up in the devil in the details of those dots and how the forecasts show up. You could have had one very strong forecast push up the GDP number within the group. There are people who believe within the administration that we'll get 5 to 6% growth this year. That was their forecast going in. If Steve Moran wrote down a number like that, that would have raised the overall growth figure, when in fact the rest of the committee is seeing a more stagflationary scenario. I do think it's a dovish pause. That is a bit disappointing right now, given where we're at, even though I'm very worried about the labor market. I just don't think the Fed can cure what ails it.
So, Diane, what do you think the emphasis, where do you think the emphasis will be in this news conference with Chairman Powell in about 5 minutes' time?
I think the emphasis is going to be on uncertainty and wait and see. And that will just sort of be where they are right now, and that they don't know where the next rate move is actually going to be. And I think that's the right way to play it.
Diane Swonk. Diane, always good to catch up with you. Thanks for being with us. Diane Swonk there, breaking down the Fed decision. If you are just joining us, welcome to the program. The news conference about 4 minutes away with the chairman of the Federal Reserve down in Washington, D.C. In any other time, at any other moment, we'd be talking about the penultimate meeting of the Federal Reserve chair, but we have not spoken to a single person today who thinks this is the penultimate meeting of the Federal Reserve chair. And most believe Chairman Powell, including the former Fed vice chair, is going to be sticking around for at least a few more months.
Partly because we don't know when the confirmation of the next Fed chair is going to be, and that ultimately lies with the man from North Carolina, Tom Tillis. Ultimately, though, there is this question about credibility for the Fed, continuity. I just wonder if he gets up there and he says, what we do doesn't matter right now. As long as we don't hike and as long as we don't cut that much, we're not in the driver's seat. I mean, ultimately, this is their pass to say, this is an economy that's moved on from us. We are not in control. We are watching it just like you.
Unspoken, John, will be the idea of the recent election results, including yesterday in Illinois. And I also point out a set of allies saying no to the president on this war, and that Mr. Powell, representing the institution, will stay around more so than the last meeting.
A big piece of this bull case for this economy and for this market has been tax refunds. We hear that phrase get bandied around all the time on this program, tax refunds, tax refunds. How big are these tax refunds actually going to be? And how are attitudes towards the economy changing given the shock of the past few weeks? Where will that money actually go?
Well, we're seeing it now when we look at Chase deposit accounts. We're seeing particularly the bottom couple quintiles of earners see their deposit balances start to go up a bit. But the uncomfortable truth is they're now paying that out again at the pump. And we can't forget that businesses and households were already paying a higher tax because of tariffs on prices. And now energy prices are going to create yet another tax on their disposable income.
Brammo, the squeeze is real. The energy bills are severe, and they were high already, and now they're getting higher.
You know, Delta and American were perfect examples of how the economy is doing pretty well and people are still spending. The difference is that the costs are getting that much higher. And so the room that people have and that companies have to do okay is getting narrower and narrower, and the Fed's watching this, and they don't have the silver bullet to really make this a better situation.
I did scientific surveillance research today.
Here we go.
EWR to Charles de Gaulle was popping the two of us. You could easily do it for $7,000, and you're enjoying it this morning just under $11,000.
Are you pretending you don't fly business class
Over three.
again?
That's well,
Is
you
that-
know, that's
is that what you're doing?
No, it's not premier. We're not doing the first class thing, but business class, I'm going to suggest, is up at least 20% instantly.
Is that Polaris? Is that United Business Class? Is that the front of the plane?
I actually don't even know. Yes, that's, yes, actually I do. I remember going to something, a demonstration about it, not actually, not exactly experiencing it. I remember seeing
for everybody to know,
we live in different worlds.
For everybody to know, out in the world, John and I are in steerage, and you're on the Gulfstream 450.
That is such a load of.
Nice one, TK. Hey, Bob, before you go, just a final word. About a minute away from this news conference. What are you looking for?
I'm looking for a couple things. I want to understand how they're thinking about the war and the elevated risk to both sides of their mandate. And then secondly, I want to know how they got to their forecast numbers. I think Diane's right. There needs to be some explanation there. And the explanation could be quite simple. It could be, well, one member put in a 6% growth rate. Okay, well, let us know that.
Well, let's get into it in just a moment. The chairman of the Federal Reserve entering the room after leaving interest rates unchanged. Let's take a listen to the chairman of the Federal Reserve.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. From last September through December, we lowered our policy rate 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total core inflation, it's about 3%, and some big chunk of that, between 0.5 and 0.75, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the S&P, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? Just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so, there are 19 people, and so 19 reasons, 19 individual submissions, and if you notice, the median didn't change, but there was actually some movement toward, a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do, but essentially it is that the forecast is that we will be making progress on inflation, not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And, the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods. And on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
That consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. That to your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. It's something quite different than that. We might have much lower than expected pass-through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one, because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down. We don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And you also, what you've written down before you'll be reluctant to move too far away from that, just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is, the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs with little growth in either demand or supply. But the U.S. economy is doing, pretty well. It's just we don't know what the effects of this will be, and really no one does.
Steve.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increases to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, your question was?
What the staff is saying about, and has said in the past.
Yeah. So there'll be an offset.
Offsets, yeah.
So that's true. We have, we're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say there's much of that happening. Not much will be happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that having looked through tariff inflation and inflation running above target and looking through the oil price shock would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully, but of course that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And, it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can cause trouble for inflation expectations. And so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And, I think it's important that we do that. Very important.
Nick.
Nick Timmeros, Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well, as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay. So I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system. And we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system so that goods inflation will return closer to what it's always been. I mean, it used to be, for many, many years, it was negative, and then, the year before tariffs came in, it was 0, and it's running at like 2% now. So, so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates, or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like where we are now, which is kind of on that borderline, the higher borderline of restrictive versus not restrictive, we feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Labor non-housing services they basically moved sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services. But we're not seeing progress there. So we do, what we expect for next year is continued, what we want to see for this year, rather, is continued progress on housing services, finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
Edward.
Thanks, Chair Powell. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable, and, in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can. We're at 3.0% core inflation, 2.8% headline. So we've been well above the 2%. That amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time, and that's a concern. We need to get back down to 2%. And we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard-pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet. And I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
You know, it's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply-side story, has changed despite the quite negative number in February. Would that be the right take, and was there anyone else in the room who thought differently, and that the February jobs report was cause for concern?
So I think you have to take the two together. You know, in a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent, really, growth in the labor force, which, of course, we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now that's balance, okay, but I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So we look at that, we see it, we get it, and I mean everybody understands the arithmetic, and that's you can say the break even is zero. But nonetheless, it's something we're watching carefully, and are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless, something we watch carefully.
Andrew.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common, and does the central bank need to start taking account of the risk of supply shocks as a more common problem?
You know, we did go through a long period where the shocks were all demand shocks, and so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years, for sure. And it's just a very different thing, and a much more difficult thing, because it does immediately raise the question of tension between the two parts of our mandate. But has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But there's people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but I guess, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And, I wish we had been able to do some things, but we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy that the possibility rather that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case, and of course we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question, though?
I was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the Strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens, and it'll come down to how long the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Maria Luisa.
Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business services as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices?
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were discussing the risks of a slowdown in growth and at a time of where inflation remains high, it really doesn't seem that most members are penciling in a slowdown in growth.
No.
But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by a tenth, and I think that's probably to do with just growing confidence in productivity. But sorry, and your second question was just.
If there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there's tension between the two goals, right? The upward risk for inflation and downward risk for employment. So, and that puts us in a different situation. You know, when we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal, and we have inflation that's 1 percentage point above that. So calling that stagflation, it's not. I would reserve the term stagflation for a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s, and I reserve stagflation for that, the word for that period. Maybe that's just me.
Elizabeth. Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course people will feel that, but I don't want to speculate about what that might mean, because honestly that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
Victoria.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, above $100 a barrel the entire time until the next meeting, is that going to change your wait and see stance? Like, what would lead you all to move, or are you on hold pretty indefinitely?
We'll have to wait and see. I mean, we always say we're going to learn more by the next meeting, and usually we do, but in this case we're going to learn a lot, because we're going to learn 6 weeks to the day till the next meeting, and we're going to see whether what happens is it's going to be very important for the way the economy looks and the way the outlook evolves. With what happens in the Middle East, that's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about alternative scenarios a little bit, but it's just, I wouldn't bring that in here. It's very uncertain, and I just want to remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve, or even if things remain as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, made it's been strong through a whole bunch of challenges. I mean, if you go back to 2023, when we raised rates a lot in 22 and 23. And close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year. So the U.S. economy has really been just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see. And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen in the Middle East. I wouldn't want to speculate.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year. They should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, it would be over. So I don't have tons of confidence on that. I think that the theory is probably right. But as usual, the time it takes to get all the way through the economy is just very uncertain. And we found that coming out of COVID, that the inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought. So I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing is, our staff's been doing, it's very interesting. They started off with just an estimate because there wasn't a real history, and then they've built, based on the history that they're seeing of tariffs coming through into prices, they can now have an arc, and for all the tariffs they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases, and we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision. But the administration said they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Chris Rugaber.
Hi, thank you. Chris Rugaber at Associated Press. You talked about the shortcomings of the SCP in this environment. I wanted to ask about, or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value, perhaps, in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year?
No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. It's your opinion at a moment in time, which can change based on events. Sometimes very quickly. So it never locks people in. People are more than happy to be proven wrong in either direction, and so I just think we do it. And I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think, but we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one, though, I think it's even more than usual good to take the forecast with a grain of salt, because subject to just very high levels of uncertainty.
Brian.
Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is there were big price increases all around the world, by the way. Everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic. And everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly. But people are not feeling good about it yet, and it will take some years of positive real earning gains for people to feel good again, we think. But you're right. But when you talk to people, they do feel squeezed, and there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive, and that's just catching up really from inflationary pressures that take a while to get to into the price. So we take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing, and what it does for us is, makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and stable prices is half of our mandate. It's one of our two mandates, maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States anywhere in the world, in a market economy, in a democracy, and you'll see, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have. But it's critical that we have that so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or specific answer on the first question. We're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. In terms of diesel prices. So your question there is, are we concerned about it? I mean,
how concerned, and whether or not it will drive up, the cost of food and other goods that really rely on it to
So
move
I think
across the country.
it's a more general concern than that. It's diesel prices because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many, many things. So, and those, there are big effects in headline inflation, but things like that leak into core as well. And the effects may not be as big, but they're quite real and they're material. So we are aware of that and we're watching it, but we're right at the beginning of this, and we don't know how big we just don't know how big this will be and how long it lasts. It may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see.
Thank you.
Archie, for the last question.
Thanks very much. Just to sort of stare into the future for a little bit, I was looking at the longer run bits of the SEP. I noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, I think it's just productivity. We actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago, and that's not because of generative AI. We won't know for years what it's really due to, but it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive because there was an incredible labor shortage. But I think economic forecasters are very skeptical of periods of high productivity because they're so rare and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity, and by the way, expect it to continue. And we haven't really started to see the effects of generative AI, and that should certainly contribute to that. So it's quite unusual, and it's this is the higher productivity is the thing that allows incomes to rise over time, and so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that, and just briefly on that as well to finish up. You hear the argument a lot, this is a sort of disinflationary story, and if you believe that productivity thing, that should also weigh down inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question, because it's really is the demand growing faster or slower than the supply side. And I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.
The chairman of the Federal Reserve. If there was a good meeting to scrap the forecast, then this one was probably it. The chairman de-emphasizing the projections, re-emphasizing the uncertainty, focused on the shock in the Middle East. We had one question: how would they respond to it? Would they look through it? The answer: it's not that simple. Equities in response negative. Near session lows right now, down 1% on the S&P 500. Likewise on the Nasdaq. In the bond market, 2s, 10s and 30s. Yields higher, particularly at the front end of the yield curve, up by 7 basis points on a 2-year, 3.75. If you, like me, thought this would be boring, this was not a snooze. The Federal Reserve Chair asked about succession. Take a listen to what he had to say.
If my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet.
3 points from the chairman of the Federal Reserve. Let's go through them individually. Point 1, I will stay on as chair until a successor is confirmed. Point 2, I have no intention of leaving the Fed while the DOJ investigation is ongoing. And point 3, even after that is complete, I haven't made a decision on how long I'll stay on. A big headline in that news conference.
He actually engaged with the question. We all were wondering whether he would give some sort of clarity, and we've got it. He is going to be the Fed chair until Kevin Warsh is in the seat. There's this question of what is well and truly over in terms of the investigation actually mean. A lot of people are going to be wondering that. And the fact that he hasn't made a decision yet. What is going to tip the scales for him to understand when he can make the decision? Either way, this wasn't a boring news conference in any way, shape, or form.
If we can bring up just an intraday chart, the front end of the yield curve, so bring up the 2-year intraday, and just have a look where things started to pick up. The Fed chair throughout this news conference was leaning into anchoring inflation expectations. That was notable. But we started to really bounce out to session highs when he started to lean into that question about his future. And I just wonder, Bremo, we can have that conversation with guests over the next 15 minutes or so, whether those two things are connected to some extent.
On the margins, this market seems to be treating a Kevin Warsh Fed as being more dovish simply because we have President Trump tweeting or Truth Socialing every single day saying, too late, Powell needs to lower rates. Right now you see there is no full rate cut getting priced into the Fed funds futures until June of next year. So that's how far we've pushed it on. There was a 1-2 punch. Fed Chair Jay Powell also said it's too soon to know the full economic effects from the Middle East. And then he said he would stay on. And we have known this is a pretty balanced Fed. They're weighing the risks. And clearly the specter of 2022 hangs over his Fed chairmanship.
Okay, you'll go out to the specter of it and the view forward. I like what Liz Ann Saunders does, retweeting Claudia Sahm. Finally, Powell throws the SEP under the bus. Skip it. Thank you, Dr. Sahm, for that. My observation, John, is it's 10:21 p.m. in Doha. And I'm looking at the headlines while the chairman's speaking, and I get the Warsh view forward and the crystal ball gazing out 6 months. I think we got to gaze out 24 hours right now. That's the tension I see in the Iran headlines that we get out of Tel Aviv and we're getting out of Dubai right now from Bloomberg.
This is why it makes it so difficult to provide forecasts in a moment like this one. And the chairman quite rightly talked about the need for humility, the duration of this shock.
Yes.
Energy assets are in play in the minds of some people now after the strikes we saw on Iranian energy assets just earlier this morning. Crude at the moment at 109 on Brent, WTI around 98. The chairman is well aware that they've missed their inflation target for the previous 5 years, overwhelmed by a series of shocks, and this is another one. Now, you may still believe ultimately this Federal Reserve will look through this shock, but that wasn't a chairman that wanted to make that point in this specific news conference.
He didn't want to say the T word, even though essentially this forecast would suggest transitory. He tried to play the part of an oil expert. He tried to play the part of a generative AI expert, but nonetheless, he said it is too soon to say so many times over again that we lost count. They are facing off with a series of shocks with the backward view of what happened in the post-pandemic era where you had inflation that creeped up to 9%. He will not want to continue that, especially with core PCE creeping higher in the wrong direction before even getting this oil.
The headline to me, John, I know we got to get to Dr. Sluck, but
sure.
The headline to me was a lack of dissent. I mean, this was very Greenspan-y and everybody on the same page supporting this chairman.
The standout here, TK, and for our listeners and our audience worldwide just tuning in, the decision dropped about an hour and a half ago. The interest rate remained unchanged. The median dot still implied one cut for this year. Lots of noise, though, beneath those headlines. The outlook for growth was better. The outlook for inflation was higher. But that single dissent was Governor Myron. And Governor Waller was expected to dissent. He sat around this table only a week, 2 weeks ago and said it depends on the next jobs report. An hour later, the jobs report came in way weaker than expected. And we all thought, we know what the governor's going to do. He's going to vote for an interest rate reduction. And then he didn't. And that's off the back of the shock in the Middle East, and that's more than notable.
Governor Chris Waller, I think, is arguably the most interesting person on the Fed right now in terms of what his decision actually was driven by. I'm curious if he comes out and says he is getting spooked by the direction of core PCE. He's getting spooked by the component of what oil prices do to that. And we talk about wage inflation. Wage inflation is still running above where it was in the pre-pandemic period.
Hey, John, I was looking at F1 in Japan here, and you said do something serious. So I looked at the price of oil here, as you mentioned earlier. Brent crude up 81% from whatever the bottom was. Saudi light, Persian Gulf,
the physical market,
145%. Same number.
This is
80%, 145.
It's the point that Jeff Curry of Carlisle was making a little bit earlier on this morning. There's a big gap right now between the physical market, where spot is trading, and the paper market, and he thinks it needs to close. He thinks the paper market needs to wake up to the real risk emerging in the Middle East. That's one opinion, one view. Other people aren't as concerned, but ultimately, that's his opinion.
Every oil strategist that comes on says, why is everybody else so complacent? What we're seeing is really a different scenario than we've ever seen before. And a lot of people say, yeah, you guys always get it wrong. And so ultimately, this debate will continue to play
What did we
out.
say a few weeks ago? If you want to make a fool of someone on Wall Street, ask for a crude forecast. That's always been the way. It's the hardest thing to forecast. Thorsten Slock is not a fool. He joins us from Apollo. Thorsten, good afternoon. Good to see you.
Good to see you.
You've had some time to go through this one. Your big reaction, please.
Well, I think one interesting thing here is that if we begin to describe everything as another shock, there's another shock, there's another shock, and we're looking through that, it almost makes it sound like, well, I don't really have to react to anything because I've identified, well, now there's just another shock coming along in oil prices. There was another shock from trade war. There was another shock from COVID. It makes it sound like that you should never do anything as a central banker. So now we have a shock that is very serious, and it's very, very clear that they decided to just basically completely ignore the Middle Eastern shock that we're facing here. So from that perspective, it is quite interesting, as Lisa is saying, why was it that Waller suddenly changed his mind? Because it must be that he did put more weight on the Middle Eastern and the Iranian shock than what the average committee member did here.
Do you think that you can infer anything from the price action as John was laying out, the idea that 2-year yields and 10-year yields inflected upward, as Fed Chair Jay Powell said that he planned to stay on should there not be another Fed chair nominated and in the seat by the time his term expired?
Absolutely. Let's just talk about it the way it is. At the last meeting, there were 10 people voting for interest rates to stay unchanged. At this meeting, there were now 11 people voting for interest rates to stay unchanged. It's very clear Steve Iran at both meetings voted for rates being lower. But at this instance, when he suddenly now says, I may be staying on until this is well and truly investigated and complete, the risk is beginning to rise that, well, maybe we'll have another hawkish member sitting sitting for a longer period, and assuming therefore that Trump will appoint a more dovish member, that does of course lean more towards that we will have a more hawkish Fed if he does stay on for a longer period.
But he's not hawkish. Why is he considered hawkish?
Well, he's hawkish relative to the alternative of a more dovish member coming along.
You were weaned at Deutsche Bank under Folkers Landau with Adam Szyminski and Paul Sankey. Their back of the report Excel spreadsheet was absolutely definitive about the supply and demand of hydrocarbons. Take that experience now, and how do you apply that at Apollo when you look at the American economy?
Well, it's very clear when you think about demand and supply in oil that the supply equation just changed quite dramatically now that we suddenly have much less supply because of the Strait of Hormuz being closed and because all the cascade of effects that are likely to come along if this does continue for a longer period. So on the supply side, we will likely continue to have the very important question, namely how long time is it going to last before we get supply up to the levels where demand is. And if that's going to take a longer time, then the risk is that energy prices and oil prices are going to stay more elevated. It's also fuel prices, of course, that are, of course, going to jet fuel. It's also, of course, fuel prices that are marine fuel. All these parts of energy complex are absolutely seeing some upward lift, and the longer the shock lasts, the more we will see energy prices stay more elevated.
When does this get real for you? At the start of this crisis, and we can call it that, people came on Bloomberg surveillance, on Bloomberg TV, and made the point that if it's days, not weeks, it's okay. And here we are more than 2 weeks into this, and now we hear if it's weeks and not months, it's okay. When is it not okay?
Well, the next one will probably be people saying if it's months, it's not quarters, then we will also have a change. So you're absolutely right. The fear is, of course, that if it does continue at the Fed level, if you put this into FERPAS, the Fed's model of the U.S. economy, it has to last at least 1 quarter, because that's the only way you can get a real serious shock to begin to feed through. If it begins to last, of course, several quarters, then it's a much more serious effect. But it is ultimately about that duration question, and that's what the market is trying to figure out. And the Fed very clearly told you today that they do not think that this is going to last a long time.
Mike McKee in the news conference. He's run back out for us. Mike, welcome back to the programme. Some key headlines in that news conference. What jumped out for you?
Well, I think 2 things, John. One, there was a sort of more humble aspect to what Jay Powell was saying. When it came to tariff price inflation, he was conceding that it wasn't doing what they thought it would do, lasting longer than they had anticipated. And now layer on top of that inflation that will come into the energy markets and perhaps others because of oil. And so he was less saying the idea that, well, we're prepared to go either way depending on what happens with the economy, as he was saying, we've been fooled. And we're not going to put ourselves in that position. We're going to sit back and wait so that we don't react wrong because we've been wrong. The other thing, of course, was what Powell said about whether he's staying on or not, because he's refused to talk about that so far. He did acknowledge what his lawyers told the Department of Justice in their deposition. But the most interesting thing was he said he's staying as chairman pro tem, and that's the law. Well, there's a presidential counsel's office memorandum that says, no, it's the president who can appoint somebody as the chair pro tem. So we could be looking at another big legal fight down the road if they don't get Kevin Warsh in there by May 15th.
Yeah, Mike, this is where the problems arise with the chairman really engaging in this topic this afternoon. Does it provide consistency or just introduce even more controversy?
Well, he's trying to provide consistency, I suppose, by saying not much is going to change until my successor gets here. But whether or not that's a shot at the president or some sort of way to push back on the pressure he's been getting, we don't really know. But at this point, you have to think the White House is going to disagree with that interpretation of who's chairman pro tem. Now, it's important to realize, too, that the chairman pro tem of the Board of Governors is largely irrelevant for a short period of time until they get Kevin Warsh confirmed. It's staying as chair of the Open Market Committee that would really bother the president, because, as Torsten was just saying, leaves somebody who's more hawkish, more likely to vote for a hold on the board.
Mike McKee with the latest. Thank you, sir. Appreciate it. Great job, as always. Mike there at the Federal Reserve down in Washington, D.C. Torsten, can you answer that question? We've touched on it briefly with you. Just expand on it. Does it provide consistency or introduce controversy?
Well, it would definitely be a lot cleaner if you have a Fed chair and then that Fed chair walks out, and a new Fed chair sits down, and then we continue with the new Fed chair.
That's how it usually works.
That's how it normally is. That's how we want a Greenspan, I've got on a Yellen, under Bernanke. But now that you suddenly have this issue that the existing Fed chair, either he may stay on the committee, which is also a huge issue, or we may not have Kevin Walsh in the seat. And as Mike was just saying, that will raise all these other legal issues around, well, is this something that you can do or not do? And that, of course, begins to just raise a lot more uncertainty about Fed independence and what is the institution making of decisions.
Do you think that it's leading market participants to not take into account some of the forward guidance or some of the discussions on the Fed, that there is less credibility as a result of some of the increasing political rhetoric around this institution?
Well, I think that we are moving towards a Fed where the focus will be at the extreme on dissents. Today we had 11 versus 1. That was very clear. But going forward, we are likely going to have, especially over the next several quarters, as other FOMC members might be leaving, we will have much more scrutiny of what are the existing members saying, what's the differences in speeches, what's the differences in footnotes between someone who was dovish, someone who was hawkish. We are entering an era of Fed watching where things are getting much more complicated because it has this political dimension of why is this person saying this? Is this person staying on the committee for political reasons? It just opens up a whole different dimension to Fed watching than what we've been used to for a long time.
Fed parlor game, but you're expert at this. On a global basis, this central banker to the world, to borrow from Bill Rhodes, Jerome Powell has to look at the varying energy intensities with Brent crude at nearly 110 a gallon. We've gone 106 to 109 here right now off headlines on the Bloomberg. When you look at the way EM is crushed by these prices, food, energy, and the rest that you're expert at, Torsten, does the dialogue just shift from the conventional parlor game?
Well, there's been discussion about the swap lines. There's been discussion about, in the broader context of things, what is the Fed's mandate? And is the Fed's mandate to take care of the U.S. economy and the people who live within the U.S., 50 states? Or is this someone who is supposed to take care of the global economy? And it's very clear that the trend of travel here certainly seems to be that we're moving towards that the Fed should really be caring mainly about the U.S. economic outlook.
Is it expressive currency? Is that what we're not seeing in the Q2?
Well, given that foreigners own roughly around 20% of treasuries, 20% of credit, and roughly a third, of course, also of equities, we still have a situation where foreigners do play a very important role in U.S. financial markets. So that key issue of what is the goal of the Fed becomes very, very important.
I'm just struck by how historic this is. The last person to stay on at the Federal Reserve as Fed chair after his term was Mariner Eccles. This was in 1948 when his term was up, and he stayed on because he was concerned about the post-Bretton Woods order and an economy that was torn from the war that we had just seen, and he wanted that consistency. That was the last time this happened, and I just am struck by the historical parallel at a time when we are questioning geopolitical alliances, when we're questioning how exactly some of these monetary policies are going to work in an inflationary world at a time of increased government debt. It is interesting that we're dealing with the same discussions, and I think it can't be forgotten, these sort of echoes that we feel from 1948.
I think it's easy to introduce one's opinion into this situation, so I'll just allow the market to guide us. Clearly, the chairman is concerned about a threat to independence. Is he right to be? Look at inflation expectations right now. Market-based inflation expectations have remained really well anchored throughout all of this. So whether you're concerned about the chairman's attack on the institution or not, let's just focus on the markets. Markets have decided it's not a credible threat. So does the chairman actually have a role here that he needs to play? Is this a card he needs to hold? I don't really understand that. I'm struggling with that. That's something I'm wrestling with. My opinion doesn't really matter. The market's telling me there isn't a concern with central bank independence. The market is telling me there isn't a concern with inflation expectations, and the data is telling me that the rest of the world's not worried either, because when I look at foreign ownership of US assets, they are rock solid, and for treasuries, I think they're at all-time highs at the last data point I saw, Torsten. So is there a problem here that the chairman even needs to address?
Well, that's why the key question becomes, what does confidence mean? Is it confidence by Jay Powell? Is it confidence by foreigners? Is it confidence by markets? It does become a very important debate. That's why this discussion around who will be the next Fed chair, now we know it's Kevin Walsh. There was around that time also a lot of discussion around it could have been someone else who might not have been perceived as credible as Kevin is. So for that reason, I completely agree. Who is the judge ultimately of what Fed credibility is, and where do we look, and where does the market look for evidence whether Fed credibility is being threatened?
And look how many establishment figures came out when Kevin Walsh was nominated by the president. How many establishment figures, and forgive me if you're insulted by being establishment, Gita Gopinath, formerly of the IMF, I don't think it gets more establishment than that, endorsing Kevin Walsh and saying he'd make a great Fed chair. Mark Carney of Canada, the former governor of the Bank of England and now Prime Minister, endorsing Kevin Walsh as a future Fed chair. What exactly is the chairman defending here when it is standard protocol to leave once your term is up?
Well, I think that that's a fair question. And ultimately, my personal opinion doesn't matter. And frankly, I don't know what my personal opinion is. I just think that there is a sense right now in markets, to the point that Fed Chair Jay Powell made, that even on Congress's level, they have confidence and they would like to see Fed independence continue. And that's you see in Tom Tillis's move. So what would make him stay on? I guess that's one of the questions. What would change his mind to actually remain on as governor past his term as Fed chair if Kevin Walsh were in the seat that would make him feel like he needed to uphold this Fed independence?
Jeff Rosenberg of BlackRock joins us now for more. Jeff, I imagine you want to avoid this topic altogether. So I'll ask you about the substance of the news conference, the shock from the Middle East, and whether it threatens to upend the outlook for this economy.
Yeah, I mean, look, the conclusion here on the substance really pivoted on that moment. I would argue, though, that the pivot was less about the conversation about whether he was staying on and that part of the conversation, and really his answer to the question that occurred right before that. That was the question about, hey, aren't you more worried about the employment outlook? And he definitively said no to that, and then pivoted to the challenge on inflation. And from my reckoning in the meeting, that was the point at which the meeting turned hawkish, because the majority of the discussion around the meeting is around inflation, whether it was the tariff inflation not coming down as much as expected, the unknown impact of energy prices on future inflation. So you have this kind of backdrop of forces that are pushing up inflation and disappointing the expectations for inflation to decline in the backdrop of stable unemployment rates. And so that really, I think, pivoted the market reaction to, this Fed is much more hawkish, the front end flattening, the equity markets responding. And that was the moment in the meeting where this moved from what had started out as a kind of dovish statement interpretation, holding the Waller dissent to the side for a second, into a definitively hawkish press conference.
Jeff, I'm looking right now, and we've completely priced out a rate cut for 2026. The first rate cut now isn't priced in until July of 2027. Does that matter for risk assets? Does that matter in any way, shape, or form, or has the Fed been totally sidelined by other events?
Well, I think it does matter, because that's what you're seeing in the markets, right? Risk assets are going down, and I think they're going down because of a pricing in of a more hawkish Fed. This is a risk asset market that has benefited for a very long time from a highly accommodative Fed, both in terms of price and quantity when you think about the impact of the balance sheet. So as we debate what the future Fed looks like, there's both a price and quantity uncertainty there, but both of those in the past have been highly supportive. When you challenge that immediately reprices, the Fed's near-term expectations, which you're talking about, but also the degree to which that liquidity in price and quantity is supported and will have the outlook continuing to support risky assets.
Jeff, John and I were going back and forth during a press conference about what the flight demands is going to be the first week of September. It's already up 60%. It's moved 60% into Milan.
You want an F1
already
as well?
Up as well. Jeff, where are we going to be, to both of you? Let me start with Jeff Rosenberg here. Demand destruction to me is tangible when you see a given fancy plane ticket go up 60% or a gallon of gas. What does BlackRock say about demand destruction?
Well, it's interesting because the last question in the press conference, the premise was, if you remember it, how high do energy prices have to go before you'll consider hiking rates? And that just misses this whole point about demand destruction, because the scenario where this goes on longer and is more disruptive to oil prices is a scenario where you shift the focus from inflation, which is today's and really the last couple of weeks' story, to a growth story. And it's not how high do oil prices go before you hike, but how high and for how long do oil prices get before you cut. Precisely. And I think that's the swing there.
Charleston, that's exactly where I am, is that this is a GDP story of constructing GDP under massive price stress.
Absolutely, because now we'll begin to watch on the weekly data, on the monthly data. We have data for how many miles are driven in the U.S. We have data for how much money is spent on gas at the pump. We also have data for airfares and how much people are spending on buying airline tickets. So for that reason, if those things begin to come out, especially even the anecdotal evidence of this slowing down, this should begin to be more worrying.
John, close the loop with you. Utility prices in the United Kingdom, it's the same thing. We're not, I mean, I think Jerome Powell's aware of this, frankly, but the zeitgeist is not talking about the GDP demand.
You're going to get me in so much trouble with regards to the UK. They've got a problem over there, and his name's Ed Miliband. I'm going to leave it there, and you can sort that out yourselves because I don't live there anymore. I'm going to talk about the shock with COVID and the inverse, the mirror image of what we see now, which is something Jeff Curry of Carlyle was talking about earlier on this morning on Bloomberg TV. In COVID, we had a massive demand shock, and it took negative prices to rebalance the market. The Hormuz crisis is the complete inverse of that. So you've got a massive supply shock that requires much, much higher prices to rebalance the market. So to your point, the question is whether $100 in the paper market and futures right now, and a futures curve going out to December that prices something in the high 70s, is sufficient enough to do that at the moment.
Well, that's why what's interesting about also what Tom is saying, if you look at the SEP, they revised inflation up. Let's just agree, that makes total sense. But they also revised GDP up, telling you that they're not assuming any demand destruction whatsoever. Is that in the textbook? So, well, the textbook would certainly tell you that an oil price shock is stagflation. You get higher prices and lower GDP, and there was no evidence of that in the SEP today.
Jeff, that's a big question. I think it's an important one. Where's the hit to growth from the higher inflation, from the higher outlook for energy prices?
Well, it's certainly not in their forecasts, and that's the clear kind of takeaway is that the forecasts are basically talking about a temporary, transitory, to use that word, impact. So that's not in the forecast. I don't think we want to take too much away from that because if you look at page 16 of the SEP, it talks about the uncertainty in the forecast. The uncertainty in these forecasts is greater than the mean, and so that really tells you there's not a huge amount of forecast accuracy here. So let's kind of put aside that these are actual forecasts of where we're going to go. For what is really important here is it kind of tells us about the tone and the consideration of the committee. And that is basically, and Powell talked about this, a little bit of upgrading. The longer-term upgrade to growth, I think, is the message. The little bit of the longer-term upgrade to the Fed funds terminal rate going up. And it's a little bit of a productivity story. But that is ignoring any kind of short-term impact becoming bigger issue for 2026 in the economic outlook from the oil price shock.
Hey, Jeff, it's good to see you. It's great to catch up. Jeff Rosenberg there of BlackRock, breaking down some of these moves with Brent crude TK getting closer and closer again to 110.
Well, just under 106, and we're popping up 109.38. A set of headlines coming off of our Dubai desk through T-Live. And I'm sorry, there's miselection here. It's 10:43 at night. It starts for another evening in the Persian Gulf.
Would you like the F1 rant now, since you brought up Formula One and Monza in September?
You and I are going back and forth.
Got a few minutes left.
I mean, you know, we've both been medicated, but I'm sorry. It's just, it's not good.
$1 billion Mario Kart. Seriously.
I
watching a computer game.
I love the Apple coverage, and it's tragic they have to deal with the truly, as Verstappen would say, the shattering of the sport.
It's not racing. If the racing driver is going through the corners, slowing down to harvest battery power.
Can they fix it now, or is this going to take a committee meeting 1 year out?
I hope they can. I have doubts they won't. There's going to be a lot of pressure on them if the fans start to depart. For me, this is for the tourists, not for the purists. And if Max Verstappen steps away from a sport he loves, imagine any other sport where the biggest star in that sport is thinking about a sabbatical. And right now it sounds like he's thinking about a sabbatical.
Again, it's exciting. Now, they canceled the 2 races in Bahrain, in Saudi.
Because of this crisis.
And, you know, life will go on. But, you know, it's, again, the unexpected, just like we faced here today.
Going to park the F1 now. We're done with that? Yeah,
no,
good.
I think it's fine.
Rama's going to start throwing stuff at us.
Oh, no, I'm enjoying this. I honestly was going down a rabbit hole that no one needs to go down.
I can't afford to fly to Milan now.
Oh, come on, you and the fam?
Goodness, no
Over
way.
to Monza, September 6th?
Absolutely, I'd love to.
Bramo can do the unemployment report.
I'm not going to make that happen anytime
I'll be here
soon.
like, the world is falling.
Torsten, it's good to see you. Torsten Slok there of Apollo. I thought that would be a boring news conference. It was not a boring news conference, and this is a story that's going to run for a while now. Succession planning at the most important central bank on the planet, arguably the most important financial institution on the planet, has totally broken down. That's the problem.
That's a problem, but also this is a Fed that's not going to come in and rescue equity markets with this concern of exactly how this is going to settle out. And equity markets are taking notice.
Because they can't. Crude right now, Brent, close to 110. Coming up tomorrow on Bloomberg TV, we'll catch up with Krishna Gua of Evercore and a whole lot more. From New York City this afternoon, good afternoon. This was Bloomberg Surveillance.
I believe that talent is equally distributed, but opportunity isn't. But education can give everybody the opportunities that they deserve to fulfil their potential. That's why I got involved in politics and why I got involved in the Labour Party.
At any point in your tennis career, did you say, I've had enough and I'm just going to retire at the top? You ever worry about that problem, staying too long?
It's a great question, and it's one that I think every athlete finds a different answer to. Mine came a little bit later than when I would have liked. I think stubbornness was a great quality that shaped a lot of my victories, but in the end of my career, I think it became a flaw because I was so stubborn to get healthy, for my shoulder to recover. I was also at an age where just my body didn't recover as quickly. And so for a year or two, that stubbornness got in the way of other great things in my life.
What would you say is the thing you're most proud of having done as a tennis player? Was it winning Wimbledon? What was the highlight of your tennis career?
I'd say consistency. I think consistency is, you can have results and they could, come at various times in your career, but I was consistent for many years, and you have to show up. You don't just show up to play first round of the finals, but you have to show up for press conferences before every match, before every tournament, and just the consistency and the mental wear and tear of showing up week in, week out. So I felt like I consistently showed up for my team, for my sponsors. As I look back, I'm proud of that.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, Tuesdays only on Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television, top experts, great questions.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
The market's on edge with oil on tilt, the Fed in the freeze as it flies blind amid the fog of war. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romain Bostic, counting you down to the closing bell with U.S. equity indices near session lows, oil near session highs, and the sell-off in short-term treasuries resuming after a three-day reprieve. U.S. policymakers keeping the benchmark federal funds rate exactly where it's been since December, and plotting out the likelihood it will make good on that one rate cut for 2026 that it had earlier telegraphed. An updated summary of economic projections. It did show an increase in inflation expectations, but also an increase in the GDP outlook. But Jay Powell says for now, take those projections with a grain of salt.
The thing I really want to emphasize is that nobody knows. You know, the economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. That you know, to your point, if we have high, if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through.
One of the more revealing comments from Jay Powell's press conference was just wrapped up a little while ago, coming off of that 2 p.m. announcement here, keeping rates exactly where they are. But some big questions now about where we go next. Ken Shinoda kicks us off to the close, portfolio manager over at Doubleline Capital. And Ken, I really thought that comment kind of encapsulated the bind that the Fed is in right now. They obviously are looking at a labor market that, in their view, at least if you read in between the lines, probably a tad weaker than what it was, but also looking at an inflation picture that is now, let's just call it, completely uncertain.
Poor Powell, he was in a good spot. He thought he would ride out into the sunset, inflation coming down, and then oil spikes $30. And yeah, the labor market was weakening, and they thought they would be able to cut, but with the spike in energy prices, it just doesn't seem like they could cut this year. The probability to cut last night was one cut at the end of the year, and that's dropped below one cut. So it seems like unless we get a resolution in the Middle East, that the Fed's going to be on hold throughout the year.
And it gets to this idea, and Powell seemed to be very cautious about, certainly did not use the word transitory, seemed to dance around even the idea that the Fed was discussing that. But it seemed like for a while the market, Ken, was kind of viewing this energy shock, if you will, if we want to call it that, as transitory. And the idea that they seem to be positioning, if not necessarily an end to the conflict, the idea that this rise that we've seen in energy prices would not have a lasting impact on economic activity. How do you view it?
Yeah, I mean, I think a couple of weeks ago when the conflict first started, definitely the market was trying to look through it, but it seems like this is going to last much longer than anticipated. Equities are pretty volatile here, but surprisingly not down that much. I actually would think they'd be down given the pass-through of energy prices into gasoline, how that leads to consumption and spending. So I think markets have been surprisingly resilient. If this keeps going, I would expect more volatility.
Yeah, and to Powell's point, too, he sort of referenced this idea that all the talk of stagflation is probably a little bit overblown, basically saying that this is not the 1970s. In his words, that was a much more serious set of circumstances. I guess my question, though, and particularly for you, as someone who is very active in the rate space here, when you start to see yields go back up, and I think right now, certainly on the 2-year yield, we're at the highest level since the war began. What is that telling you right now about the psychology of where traders think this market is going to go?
Yeah, well, the front end is pricing in the lack of cuts. The front end is saying with inflation here, there's just no way that they could drop rates unless energy prices come down meaningfully. And then the longer end, we're kind of in the middle of the trading range. The 10-year got down below 4%. Over the last couple of years, we've kind of seen 380 a couple times. We're at 420 right now. We've seen 450, so we're kind of in the middle of that trading range. It's hard to get overtly bullish on the long end. I think kind of that 2 to 5 year portion, now that it's repriced, looks interesting. It's hard to see the 2-year rise meaningfully unless we think inflation is going to stay high for many, many years. And for now, at least, if you look at break-even inflation rates, longer-term inflation expectations, call it 5-year inflation expectations, are still sub 3%. So it's kind of hard for the 2-year to break too much higher. I think you'll see more buying there than potentially the long end of the curve.
I thought it was interesting, the relative lack of dissent, particularly given some of the drama that we saw in the previous meetings. But I do want to address the elephant in the room because, and then with regards to Powell's tenure, because it seemed like part of the case for rate cuts, at least in the minds of the market, wasn't just the economic data itself, but also the idea that you were going to get Kevin Warsh to lead this Fed, and that, in theory, was going to push the Fed in a much more dovish direction. Does the idea, as Powell addressed today, that, well, he might have to delay his vacation plans for a little bit, does that change the calculus for how you think the Fed might actually tilt one way or the other?
Warsh comes in. I know he talks dovish, but he's got to fight the mandates of the Fed. He's got to fight inflation. He's got to keep employment strong. And if inflation's high, I just don't see how he could cut the 100 basis points some people are calling for. Just earlier this morning, you have some market participants saying, yeah, buy stocks because the Fed's going to cut. I mean, the market's not pricing that in, so I don't know where they're getting that information, but they're going to have to do what the data tells them to do. They're going to be very data dependent. And I think you just have to watch that data. And if the energy prices stay high, it's very hard to cut rates.
I do want to get your thoughts on something non-Fed related. And this really has to do with what's been going on, Ken, in the world of artificial intelligence. And, of course, the CapEx spend and now the big borrowing that we've seen in that space to fund that. We've already heard from some other fund managers out there saying that, at least for right now, particularly when it comes to software, they're not really willing to wade into that space right now. Are you comfortable with what you've been seeing with regards to the borrowing overlaid with the idea of what may or may not actually be the return with regards to some of those AI investments?
Yeah, we're in the very early innings of AI CapEx spending, borrowing in the debt markets, and become a larger and larger percentage of many markets. Right now it's very small. There's a couple kind of off-balance sheet IG transactions that have gotten executed out there. There's some transactions being done in bank loans and private credit. CMBS market is lending to some data center owners. The ABS market's funding some data center infrastructure. But with time, it's only going to grow. I mean, if the market participants are right and we're going to see multiple trillions of dollars of CapEx spending, it's going to become a meaningful part of the debt markets. And in debt markets, you don't have infinite upside like stocks. Like if you're going to own AI, I joke, you might as well own the equities. Right now, the spread pickup for some of these transactions is minimal with a lot of uncertainty. So what we're doing at Doubleline is we're avoiding as much of this exposure as we can until we get paid more for it. If we see a correction, maybe we'll wade into the waters. But for now, we think it's prudent to kind of limit our exposure in that market.
All right, Ken, have to leave it there. Always a pleasure. Ken Shinoda, portfolio manager over at Doubleline Capital, counting us down to the closing bells with stocks right now at session lows, oil near session highs, and some big earnings after the bell out of Micron.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here to take you through the closing bell. Katie Greifeld is on assignment, but Carol Masser and Tim Stenovic join us as always. Welcome to our audiences across all of our Bloomberg platforms, television, radio, and our partnership with YouTube. A very busy afternoon here as we await some earnings out of Micron. And of course now, just about an hour or so removed from a big Fed decision that actually didn't move rates, but actually said a lot about where the Fed is at.
Yeah, kind of fascinating. And I think the big headline is Fed Chair Jay Powell basically, I'm not going anywhere. We're going to wait until all of this stuff is resolved. We just talked with Greg Peters over at PGIM, and some of that saying, here is a Fed Chair that is willing to stay put, not cut rates, do the right thing based on what the economy needs. And so that kind of helps explain what we are seeing in terms of market reaction. Stocks under pressure. And he talked about the yield curve in terms of a flattening, but we did see certainly yields move up.
Yeah, and not to sort of belabor the point about what we learned from the plans for Jay Powell, because I do think that was a big bit of news that we got, Romaine.
Yeah.
I guess the ball kind of moves into the court of Jeanine Pirro, U.S. Attorney for Washington, D.C., Senator Tom Tillis with the nomination process and whether or not, we could see a Fed chair nominating process in the next few months. Because if we don't, then Jay Powell, he's there.
And it's messy. And I'm just going to borrow a phrase that John Farrell used on the Fed special here. The idea of this type of a messy succession plan, if you will, for the most important financial institution in the world, no bueno. No bueno here for the equity markets as well. We started the day in the red, but they were modest losses to start. Those losses accelerated once Jay Powell started speaking, and they accelerated even further when we got closer to the closing bells. The broadest-based sell-off that we've seen in the S&P 500 all year long. Down 91 points on the day, or 1.4%. The Dow Jones Industrial Average losing 770 points, or 1.6%. The NASDAQ Composite down about 1.5%, and the Russell 2000 giving up about 41 points, or 1.6%.
All right, back to the S&P 500. No surprise as we see stocks selling off here following the Fed decision. Romain, we've got most names in the S&P lower today. 422 to the downside, 81 actually gaining ground on this Fed Wednesday. So, yeah, a lot of selling here.
And all 11 sectors in the S&P 500 are in the red. Consumer staples and discretionary stocks, the biggest decliners there. But honestly, nothing was spared. And that even includes energy. That was actually fractionally lower on the day. We should point out that as we speak right now, we are seeing the Brent crude prices climb back to those intraday highs around $109 a barrel, and yields right now on your 2-year, the highest that they've been since August.
All right, everybody, we've got Micron crossing the Bloomberg terminal, so let's go to it as they cross. Bringing up my headlines here on the Bloomberg. Second quarter adjusted revenue. Folks, pretty big beat there. $23.86 billion. Street estimate was $19.74 billion. Check out the second quarter adjusted gross margin. Investors were expecting a lot, and they're getting it. 74.9% on that adjusted gross margin. Estimate was 69.1%. Second quarter cash flow from operations, $11.9 billion. That compares with an estimate of $8.93 billion.
I'm sorry, can I just stop you there? Because I know you're comparing it to the estimates. But I just want to compare that year over year. $11.9 billion in cash flow from operations. A year ago, that was $3.94 billion. And similar story in revenue, $24 billion in revenue. A year ago, that was $8 billion, Carol.
Well, get ready to pop your eyes even more, because third quarter adjusted revenue, here's the outlook. Revenue of $32.75 billion, folks, to $34.25 billion. Street estimate was $23.66 billion. Stock up about 2% here, Tim.
Look, Sanjay Mehrotra, president and CEO of the company, says this is economics 101. It is all about supply and demand, Romain. He said Micron set new records across revenue, gross margin, EPS, and free cash flow, driven by a strong demand environment, tight industry supply, and our strong execution. In the AI era, memory has become a strategic asset for our customers, and we are investing in our global manufacturing footprint to support their growing demand.
I don't know if you read the revenue, the projections yet, Carol, so forgive me if I repeat this here, but the third quarter adjusted revenue numbers, that 32.75 to 34.25, and that's above estimates. But you mentioned the stock move here. I just want to put this into perspective. You have a more than doubling in revenue in the most recent quarter, guidance that's going to even grow, 50, 60 plus percent more for the next quarter, and the stock is only up 0.9%.
Yeah, it is kind of bouncing around here. So what are they looking for, right? I think one of the things that that investors, analysts wanted to know, it had to do with pricing and whether or not what we're seeing and whether that continues. And this certainly plays into margins. That's probably why their margins are kind of off the chart. But we've got to get a little bit more clarity on that because that is certainly something that investors want to know.
All this, I guess what I'm getting at was all this pricing. I mean, this is a stock that was up coming in today like 390% over the last 12 months. I think 65% just to start the year alone. And the question is sort of what's the bar? We saw this similar with NVIDIA when it started giving those forecasts the other day, and investors are kind of like, okay, $1 trillion in revenue, that's nice, but what else you got?
And look, I think to your point, I mean, given that NVIDIA is 17% of Micron's revenue, according to the supply chain function on the Bloomberg terminal, then maybe some of this was priced in because you get visibility through other companies and what other companies are selling.
Absolutely, and we talk about this idea of just this shift now away from the building of these large language models to this inference phase that Jensen Huang talked a lot about. And of course, it's these memory chips, particularly these dynamic random access memory chips that Micron specializes in, and it could be a big beneficiary of that. But also, I'm curious to see what they have to say on the call, because remember, last quarter, the issue they had was the demand's there, but they don't have the capacity to actually build this stuff yet. And there's a lot of questions as to how you meet that demand and whether they can do it in a fast enough time.
They said that, remember, they said they're investing in our global manufacturing footprint to support their growth demand, reflecting confidence in the sustained growth of our business. This is another headline that's crossing. Our board has approved a 30% increase in our quarterly dividend. But I think a lot of analysts, to your point, Romain, on the call will be asking, okay, how long does that manufacturing, global manufacturing expansion, how long does that take? How long until you can actually build enough to get demand or to satisfy the demand? But then also, where will we be in the cycle at that point? That's the challenging part.
Well, that's a good question. I think BI was that thing that they're apparently trying to build out there in New York State. The idea is that maybe 2028 would be that. And we're talking about a business that historically has been highly cyclical. And I know we're kind of not in a cyclical phase now. It's more of a structural phase. But to your point, what is the market going to be like in late 2027, 2028, if they do start to bring additional manufacturing on?
All right, I just want to go to Dina Bass actually posting a story on the Bloomberg. So she says Micron offering a positive forecast for the current quarter after surging prices for computer memory chips bolstered its prospects. She got to that fiscal third quarter revenue being approximately $33.5 billion. Profit will be $19.15 a share, compared with analyst projections of $23.7 billion in terms of revenue for the third quarter and $11.29 a share for profit for the third quarter. But again, she goes to memory prices. She says they're soaring because of shortages fueled by AI computing demand, and the global shortage is likely to persist another 4 to 5 years due to constraints in semiconductor production. Folks, this is basically supply and demand. When there's not enough supply out there and there's a lot of demand persisting there, prices go up, margins go up. It makes these companies much more profitable.
At some point, though, doesn't that begin to work against them, Carol? Isn't that kind of the problem? Is at some point people are going to be like, we can't afford this. And let's face it, I mean, to kind of circle this back to the Fed as well, and of course what's been going on in the Middle East, there's been a lot of discussions about how we could actually see more upward pressure on prices because of the disruption of a lot of the key chemicals and supplies you need to make this stuff.
I think you bring up a good point about potential disruptions, but if we play this through and talk about, again, NVIDIA being its biggest customer, NVIDIA has a lot of pricing power right now because there really is nobody else that can produce a lot of what NVIDIA produces and sells. So as long as NVIDIA continues to have that moat and can control prices and say, okay, well, this is what look at NVIDIA's margins. Until those take a hit, then maybe Micron can keep increasing prices because NVIDIA passes those along because NVIDIA passes those along to customers.
I mean, their biggest customers, NVIDIA, Lenovo, Microsoft, Dell, Apple, Amazon. I'm guessing these guys have the money to do it. Like, they keep tapping, we know, the debt markets and so on and so forth. I have not seen any of them say we can't afford to actually spend on this. I don't disagree with you, Romain. At some point, you do wonder, when does this start to slow down? But at this point, everybody seems to indicate that the demand is still there.
Yeah, look, I mean, the money's there. The question is, when does it stop being a wise use of the money? I'm really curious to see what they say on the conference call, which is I think it's going to be at 5:30 p.m. East Coast time today, and whether they can kind of articulate a little bit more about the build-out, potential manufacturing build-out, but also how long they think this cycle could potentially be.
And on that, Dina Bass just saying in the AI market, Micron is working to ramp up production of new high-bandwidth memory, or HBM4, and she says and writes and reports, a big question is how much NVIDIA will rely on Micron for that component, and that's where it kind of also gets a little tricky. All right, guys, we're going to continue certainly watching this one in the app.
Unchanged Studios?
Well, I was going to say, Romain, maybe you and I should go into memory selling.
I'm so glad you noticed so quickly.
There's so much demand.
We should. I'm still
nothing gets past you, Romain.
Going through my storage unit, finding laptops from 20 years ago.
Micron's down about 1% now, guys, in the aftermarket.
Like a scrap dealer.
Down.
Yeah. Talk about moving up and down here. All right, guys, that's a wrap. Nice to kind of just chat with you, Romain.
It was nice.
I mean, I love all your,
You were smart today. I like it.
All right, that is a wrap. Across platform, radio, TV, YouTube, and Bloomberg Originals. Romain, just there solo over on the TV side, continuing, of course, on the close. And Tim and I continuing on Bloomberg Business Week Daily right here on radio. Folks, we will see you again, same time, same place tomorrow.
Another blockbuster quarter for Micron, though the share is under pressure here in the after-hours trade. We're going to talk about this structural cycle that we're in right now when it comes to chips and memory chips, specifically Matt Bryson over at Wedbush. He joins us in just a second, right here on The Close on Bloomberg.
top names at the Fed are on Bloomberg.
I have projections for unemployment. I have projections for inflation. So do my colleagues. And thus far, the evidence from events over the weekend haven't led me to change any of my forecasts.
With the geopolitical events that we talked about, it's just too soon to know what imprint this has on inflation and for how long.
We've seen the economy overall. It's been pretty healthy. It's been brightening. The outlook has been positive.
I'm just watching prices at the pump. They've jumped up over the last week. You can see that when you drive around. But of course, no one knows whether this is going to be short-term or long-term, and so we'll just see where it goes.
Inflation's hot. It's going to look even worse now with the oil prices, at least on headline. And then if you get a solid job number, it does say you can sit there and wait.
It can lead you in a stagflationary direction. The inflation side of the mandate getting worse at the same time the employment side of the mandate is getting worse. And that's always the worst case scenario.
Nobody covers the Fed like Bloomberg. Context changes everything.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism. This week, the Fed's reaction to the Iran war with Randy Quarles, former Fed vice chair, how Australia's attempt to limit social media for young people is working out, and a different view on AI. What if, after all, it's simply a normal technology and not the revolution some predict?
Let's look at reliability separately from capability. Capability is not enough.
Watch Wall Street Week. More than what you need to know, it's what you need to think about.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Romaine Bostic. We take a look at how U.S. equity markets closed out the day, and it was a down day. Accelerated selling into those closing bells, down about 1.4% on the S&P 500 for the broadest based sell-off that we've seen for the benchmark index all year long. That, of course, was tied to a lot of concerns about the uptick in inflation amid the war in Iran and a Federal Reserve that, at least for right now, seems a little bit paralyzed with what to do next. Your two-year yield, that is, of course, the yield that is most sensitive to Fed changes, that is up 9 basis points and now at its highest levels going back to the summer of last year. Brent crude prices that are in the new session, they're actually trading above where they were in the previous session, $110 a barrel. Spot gold down about 3.4% here on the day. As for the individual movers, you got no help today from the big tech stocks. Microsoft was down, as was most of the Mag 7. You did have a few bright spots there, including Cloudflare on the back of some reporting here about a potential stable coin. And you had a newcomer to the market, Swarmer, that is the AI drone company, which rallied 500% on Tuesday, up another 77% today. And SanDisk during the regular session was up about 5% on the day. But SanDisk, of course, now under pressure here in the after hours trade on the back of those earnings out of Micron. And that does bring us to our top story to kick off the hour. It is a focus on the economy, but the main pillar that has kept it and the stock market afloat, the unrelenting spending on AI. One of the biggest beneficiaries has been Micron, the biggest U.S.-based maker of memory chips. It's been riding high. Revenue in its most recent quarter, the fiscal second quarter, came in at $24 billion. That's 3 times what it was a year ago, and almost 4 to 5 times what it was a couple of years prior. Quarterly net income surpassing $14 billion. That's almost 8 times what it was just 4 quarters ago. Micron stock, the best performer in the Philadelphia Semiconductor Index over the past 12 months, and 3rd best performer in the NASDAQ 100, almost quintupling in price over at that time. But of course, those high numbers bring high expectations and a lot of questions now about where we are in this memory chip cycle, how long it can go, and just how much Micron will benefit. Matt Bryson joins us right now, Managing Director of Equity Research at Wedbush Securities. And Matt, I mean, look, let's just start off. This was a phenomenal quarter, a blockbuster quarter in terms of the aggregate numbers, in terms of the growth, in terms of the margins. I don't think there's a number in here that you can really quibble with. However, I am curious as to where we are in this super cycle, or whatever we want to call it right now, and whether investors should still be riding it or maybe be a little bit more cautious.
Yeah, Romaine. So I think we still have some room to go. Memory is very much a supply-driven business. So it's not how much demand there's out there. It's can the vendors bring on enough supply to meet that demand? And because you have these long lead times for fabs, we don't really begin to see new supply coming on until next year. and it may even be 28 before Samsung, Micron, Hynix can catch up with all the demand from AI.
But is there a sense here, though, that there's any sort of negative to this? And by that, I mean, the idea is that if the demand's there, will it be there? We were talking a little bit earlier on the program, the idea that once you start to get manufacturing capacity up and running, will that cycle still be there to support that expanded capacity?
Yeah, at least from what I'm seeing, companies have already set their purchase orders for things like HBM for 2027. So I think if those large customers are certain enough that their demand is there to place orders, then Micron and the memory makers don't have a demand problem yet.
We are getting additional headlines now. They are addressing some of these issues right now, talking about that they still see a tight DRAM as well as a NAND market beyond 2026. I think they've kind of said that before. It gets to the question, too, Matt, that where are we right now with regards to just the AI build-out? And I bring that up in the context of what we heard from Jensen Huang earlier, who talked a lot about how we're kind of shifting now to this inference phase, which, of course, brings a whole different set of power demands and chip-style demands as well as memory demands as well.
Yeah, so Jensen told you he's got $1 trillion in business between Blackwell and Rubin. And by my math, that shows some slowing in 27, but you're still looking at something like 40% annualized growth off of really, really big numbers. And so if you believe him, and he's got better visibility probably than anyone else out there, then there's still a fair amount of growth left with AI.
All right, Matt, really appreciate you giving us your snap opinion here as we await that conference call in just about an hour or so's time. Matt Bryson, Managing Director of Equity Research over at Wedbush Securities, a blowout quarter for Micron Technology and guidance for the current fiscal quarter of revenue of roughly about $33.5 billion. When we come back, we are going to turn back to the Fed, and we're going to turn to Jay Powell and his future. Apparently, he might be staying put for a while. Former Vice Chair Lael Brainard joins us in just a second to talk about what comes next. This is The Close on Bloomberg.
I'm Francine Lacroix, an award-winning journalist. I've interviewed everyone from world leaders to fashion icons about the news of the moment. But I've always been curious, who are these people as leaders? Start your week with me exploring what drives the world's most influential people and what we can learn from them. So tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
Breaking news on this Saturday morning.
There's really only one story, and that is Iran.
Balance of Power has all the angles covered.
Trust Bloomberg for on-the-ground coverage.
An entire region pulled into this conflict.
Talking to you from the bomb shelters.
Up-to-the-minute reporting.
Iran remains a viable threat.
And the analysis you need.
There was no imminent threat.
There's never a good time, but there are better times.
Netanyahu is my opponent. However, on this issue, we stand together.
Nobody covers geopolitics like Bloomberg.
I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality, And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet. And I will make that decision based on what I think is best for the institution and for the people we serve.
Fed Chair Jay Powell addressing, well, I guess the succession planning going on right now at the FOMC and the Federal Reserve Board, particularly given what is still an open investigation by the DOJ. Joining us right now is Lael Brainard, former Fed Vice Chair and former Director of the National Economic Council. And Lael, before we get to the actual Fed decision and some of the economic projections, I do just want to ask you about kind of what actually transpires over these next few months with the possibility that we could actually see a sort of a chair pro tem situation with Jay Powell. We could see him stay on as governor, particularly as this DOJ subpoena case, whatever we want to call it, remains unresolved and could actually hold up Kevin Warsh's confirmation.
So clearly, he wanted to put that statement out there today to be very clear that his leaving the board would be contingent on that criminal investigation being terminated. And of course, that lines up with Senator Thom Tillis, who has said that he will not move forward on the vote for incoming nominee Kevin Warsh until that criminal inquiry is dropped. And the administration has a very clear path to do so. The statement on the part of the district court judge, very clear. They did not see a case here. And so by simply not moving forward with an appeal, it would clear that path, at least to get Kevin Warsh a vote and to get him onto the board. What happens after that, Jay Powell wouldn't say.
He would not say. He also wouldn't say a whole lot about the inflation situation. He was asked. He answered it, I think, the best that he could. But he also seemed to make clear that right now, no one really seems to know anything. I thought his comment about the summary of economic projections, which was basically, hey, we had to write something, so we wrote it down. But that didn't sound like there was a whole lot of conviction that forecast, whether it's on the GDP side or the inflation side, is something the market should put a whole lot of stock in. How did you view it?
Yeah, I found it surprising. We did not learn really anything about how the committee is thinking about the effects on inflation and the economy from the oil price shock, neither in the statement nor in the summary of economic projections. Yes, they marked up core inflation a few tenths, but that could simply be reflecting the reality that core PCE has actually moved up a bit in the last few months and is expected to be a bit stickier than before. But what was interesting is that he wouldn't use the word transitory, but essentially they look like they are treating the oil price shock as transitory.
Well, yeah, and he was very careful not to use the T word. But I am curious about this idea of just the compounding effects of everything, because I think one reason why I think the market talks about it being transitory, because we've kind of been here before, whether it was obviously the supply chain issues with regards to COVID, and then obviously whatever happened with the start of the Russia-Ukraine war here. Is there a reason not to view this as potentially transitory?
Well, I think that we have to at least consider two reasons this time may, in fact, be different. One is that the size of this oil shock is unprecedented. The Straits of Hormuz have not been closed before. 20% of oil production. That is very material, and nobody knows how long this is going to go on. The second reason that I think we have to be a little bit cautious before we dismiss this as transitory is this oil price shock comes on the heel of a series of supply shocks. Very significant tariff shock to the supply of labor, and of course, coming off even earlier, a period of high inflation. In the kind of circumstance where you have a series of supply shocks that individually might be actually transitory, you do have to worry, and I did back when Russia invaded Ukraine, you have to worry about the cumulative effect on inflation being somewhat more persistent.
With regards to that balance of monetary policy, or the balance between the dual mandate, there's been been a lot of talk about how the labor market is in a different place than where it was in 2022. And obviously, the circumstances around COVID were entirely different. How do you view the labor market right now, particularly through the lens of the potential for a more meaningful move up in inflation?
Well, it's certainly the case that in 2022, the labor market was strengthening. And now, of course, we've seen it barely treading water over the last year. And it's hard to read, as the chair said, because we've seen a reduction in the supply of labor at the same time. So they are putting a lot of store on that unemployment rate just remaining very steady, even though we've seen payrolls growth be essentially zero for the last little while. So I think there is a risk to both sides of the dual mandate from this oil price shock, both more unemployment and more inflation. And that is why this could be quite a difficult balancing act for the Fed in the months ahead. But the other piece that I think is an important contrast to 2022, in 2022, inflation was just starting to really spike up after a long period of being very quiescent. Now we are seeing an additional shock to inflation after 5 years in which inflation has been quite high relative to its target.
Well, this also gets to this idea, though, too. I mean, we've heard from a couple of consumer product companies over the last couple of weeks that have made it clear that a prolonged increase in oil prices and effectively for consumers, that means higher gas prices, is going to have a material effect, particularly on discretionary buying, but even on buying of essentials. If that does potentially end up being the case, how confident can you even be in some of those GDP projection numbers?
Well, I do think that consumers are stressed by high prices. I've done a bunch of roundtables with consumers who essentially point to food prices going up, electricity prices going up, housing prices not seeing any relief, and now, of course, gas prices for the first time in over a year are going up. So I do think consumers were already feeling stressed, and we could, in fact, see some consumption pullback. Now, on the other side of that, people are getting their checks, their tax refunds, and so that might help insulate if this is not a prolonged shock.
All right. Well, on an inflation-adjusted basis, those checks just got a little bit smaller. Lael, appreciate your candor there. Lael Brainard, former vice chair of the Federal Reserve. We should point out gas prices up about 30% at the pump since the war began. And I do want to draw your attention to the oil markets. Post-settlement trade right now has Brent crude back at $111 a barrel. WTI crude right now flirting with 99 and change. When we come back, we're going to talk about the investor. We're going to see how they're feeling. The CEO of Edward Jones, Penny Pennington, she's going to be joining us in just a second, right here on The Close, right here on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, only on Bloomberg Television.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
People write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down.
And Jay Powell there getting a chuckle out of the journalist there as he talked about that summary of economic projections and kind of making it clear, don't put too much stock in it because there really is just a lot of unknowns out there. Here to talk a little bit more about what she knows, what investors know, and more importantly, how they're feeling is Edward Jones, CEO, Penny Pennington, who joins us here live in Studio 2. Penny, great to see you again.
Romaine, good to see you.
I know we talk, look, the economy is always, to a certain extent, a little bit of a fog. We're always just trying to guess kind of where things are going, but it feels a little bit different right now, given the overhang of the war, the spike that we're seeing in energy prices. I am curious as to sort of how you approach these types of moments, which aren't, I won't say they're not common, but they're not necessarily rare either. We've been here before where we've had this type of fog here. How do you either look through that fog or grope your way around it to sort of figure out maybe what people should actually be doing and where they should be putting their money?
Yeah, well, it's great to be with you and your audience. And the reason that we come and share, Romaine, with you is what we're hearing from 9 million clients that we talk with every day. And you said being light with the reporters there, Chair Powell. None of it's any laughing matter, and at the same time, your insight is correct. We have been here before. Mm-hmm. We've had times of anxiety, of economic uncertainty, of war, of times that make people very, very anxious. However, Chair Powell said it, we got to be humble right now, about what we know and what we don't know. But the Fed also raised their expectations for productivity in the U.S. economy. They're not calling for a recession, nor are we. We don't think that that's the case. The fundamentals of the economy are strong right now, notwithstanding, and we should have tremendous respect for what's going on in our world right now and be very thoughtful about the people who are in that conflict. But that notwithstanding, prices have begun to moderate. Mm-hmm. Inflation has been coming down, albeit slowly. Interest rates are coming down a bit. So the productivity in the economy and the productivity that we may gain, and we believe this is the case from AI and generative AI, we think that's a real thing. It hasn't all come through yet.
Well, that's what I'm curious about, because prior to this war starting, there were a lot of positive signs in the economy, as you mentioned. We had mortgage rates coming down. You actually saw a pretty healthy uptick in selling and buying activity in the housing market for the first time in a couple of years. And it raises the question as to what we're seeing right now with this impact of energy prices. Does that become just kind of a temporary speed bump in all that, and the structural issues that were in place in January, February, that at some point those will dominate the conversation once again?
The way that sounds when we talk to our clients is, Penny, if I were the financial advisor, and I once was, Penny, I know what's going on in the world. How does that affect my world? And so the conversation that we have with our clients is, tell us about your goals. Let's revisit your goals for the long term. Let's revisit how you feel during a time that can feel a little anxious. Has it shifted your risk tolerance? Let's take a look at your portfolio. Does it continue to be well balanced against the goals, your long-term goals? And then as we look at how the effects of price changes, whether they be temporary or long-term, on the decisions that a client and a client family might make about not just their investment investments, but how they choose to balance their saving and investing between different kinds of goals, be it long-term goals for long-term care or retirement or education goals, or in this case, what many are facing today is legacy planning. We're in the middle of an intergenerational wealth transfer right now across 4 generations, where families are moving their wealth and their values to the next 2 generations. And so the conversations associated with that and how the current impacts affect those near and longer term decisions is what a great financial advisor is talking to clients about right now.
And, as we sort of start to go through this major wealth transfer, we're also going through a major sort of transformation of financial markets. Obviously, private assets have become much more talked about. They're not just for institutions anymore. To a certain extent, they're becoming much more available to individual investors. And even aside from just private assets overall, you've seen a lot of individual investors start to look for assets other than just, stocks and bonds, whether it's digital assets, et cetera. How do you factor that in?
Well, what they're focusing on is diversification, and diversification has been a sturdy, durable rule of the road for investing for the last 100 years. We think good diversification and high quality assets are the fundamentals for a strong portfolio. Private assets may be, under certain circumstances, a correct investment for clients to be making. It depends on the level of diversification they need. It also depends on their risk tolerance and their need for liquidity. And a lot has been written about this just in the past few weeks. Private investments are structured differently than those in the public markets. And it is also true that I think I saw the statistic, 85% of companies with $250 million of revenues or more are private companies. And so more clients want access to those early stage companies, want access to those opportunities for growth and innovation.
But when we talk about early stage companies, I mean, we have to kind of separate kind of what we're talking about here, because I think a lot of the headlines have been more, some of the more mature companies, some of the ones that were, have been kind of under the wing of private equity and private credit. Is that what you're talking about, or are you talking more companies more at the kind of VC stage
Really the entire range of private assets, but what you're getting at is so important. It is helping clients understand what sort of asset they should have in their portfolio and what kind of ride it's going to be for them when it's there. We believe that private assets should be a smaller position in a portfolio and are meant for people with generally more complex needs, longer time horizons, a greater need for diversification, but building the right expectation for liquidity, for risk, for all of those aspects of that investment are very important in the advisor-client relationship.
And are you making sure that your advisors are educated up enough on that to be able to educate their clients?
Absolutely. As we have been about emerging investments for decades, we've been around for 104 years through thick and thin with our clients. And so helping them make sense of those investments and making sense of the right place they should have in their portfolio is our job.
Penny, always a pleasure talking to you.
It's a pleasure, Romaine. Thank you.
Penny Pennington, she is the CEO over at Edward Jones. Before we go to break, we do want to check in here on the after hours trade. We are awaiting that conference call from Micron in just about 52 minutes here. The share has been under pressure after a blockbuster quarter. Of course, a stock that had quintupled in value over the last 12 months, down about 1.6% in the after hours trade and dragging down some of its peers, including SanDisk. We'll be back in a moment. This is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no. I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Asia is at the forefront of some of the world's biggest stories. And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Beirut, and this is Bloomberg.
The Securities and Exchange Commission here in the U.S. out with new guidance this week for which digital assets it considers to be securities. It's a key step on the long-fought road to crypto clarity, with the CFTC throwing its support behind the interpretation. Joining us now to discuss is the director of the Division of Corporation Finance at the SEC, Jim Maloney. Jim, thanks for being here. All right, let's get to exactly sort of what the structure is here. Basically, we're talking about things like stable coins, collectibles, digital commodities, et cetera. These will not be securities. However, things that are tokenized, for example, those end up being securities. Is that kind of the gist of it?
Well, Romaine, thanks for having me. I appreciate it. Glad to be here. Yes, the interpretive release that came out yesterday basically is an interpretive release from the commissioners at the SEC. And what it does is it breaks down into baskets the different types of instruments there can be. Correct. There can be commodities, there can be currencies, there can be securities, there can be collectibles, and then you get into the details of stable coins and tokens. And so I don't want to be too detailed about it, but the interpretive release lays the framework for exactly helping folks identify which category they're in.
Well, when we talk about this, the framework here, I mean, when do we get to the stage of formal rulemaking and the idea that this actually does become enshrined in regulation?
Sure thing. Well, I started probably about 6 months ago, and we've been actively working on the rulemaking. There is a proposing release in the works, and as you know, we have the Clarity Act that's floating around on the Hill, and there's a lot of folks working on legislation. So our rulemaking is basically setting forth a framework that will perform the foundation for the legislation when it comes. So the SEC won't have the answer to everything, but we are establishing in a proposing release how we would envision these instruments being regulated.
So this interpretive release that you put out here, that is in sync with what Congress is going to be working on?
It doesn't conflict. It is in sync. It's in sync in that it at least establishes the landscape for what is a security and what's not a security. And certain things will be commodities that are going to be regulated by our sister agency, the CFTC. So what we're really doing is providing clarity on the line between the SEC and the CFTC and other regulators, because I think up to this point there's been a lot of confusion as to who has the regulatory jurisdiction over the many different things that you see in the market.
Well, part of that confusion is because Congress has failed to act, and some of that not completely its fault, though most of it. I am curious, would you have put this out had they actually moved forward with the Clarity Act last year and passed it as they had intended to do?
We could have put it out before or after. I think that we put it out now because we realize, time is of the essence. The markets are waiting, and they're waiting for this guidance. They're waiting for clarity. So this is really not going to conflict with anything. It's setting the stage, if you will, for the Clarity Act and the legislation to come.
I do also want to ask you about this safe harbor provision, the idea that a lot of these crypto companies would not have to register with the SEC. Is that blanket, or is there some sort of nuance in there that I'm missing?
No. If it's a security, if it is a security, the instrument, then they would have to register or have an exemption. And so the proposing release to come would set up a framework, much like you do for private offering of securities in Reg D. This would be something akin to a Reg Crypto, where you could look at the instrument and say, okay, this is a security, and we don't want to offer it and sell it privately, but rather we would rather have the protections of a federal securities regulatory scheme. So this will be something that most people would opt into and will comply with these rules, assuming once they're proposed and then later after we get comment and adopt them.
I do want to ask you another issue going on at the SEC. Some reporting earlier this week about the potential of doing away with the quarterly reporting requirements for publicly traded companies, potentially moving to a semi-annual basis. Can you provide any sort of insight into just how far along you are potentially in following through with this proposal that Trump floated a few months back?
Sure. This is nothing new. These were concepts that were floated 10 and 20 years ago, and they are back on the radar because the president has put out, an announcement saying we should look at it, and so we are looking at it. We are actively working on a proposing release that would go down the path of what could, semi-annual reporting look like. We'll ask a lot of questions. We'll get a lot of feedback, and then if it makes sense, if there's a consensus, we'll proceed, forward on that basis. But I think that it's safe to say that it will be sometime this year. It will be proposing. And, if I was a betting man, I think I would say, it's probably not going to be mandatory. It might be something that's voluntary. And so companies could decide whether this is a good fit or not for them.
Yeah, but if you make it voluntary, though, does that create inconsistencies for investors where you have some companies on a semi-annual schedule and others on a quarterly?
Well, I would say there are always going to be very large companies that have the financial resources to report 3 Qs and a K. They're not going to change that. They're not going to go back to something that's just 1 quarterly report and a K. This is really, I think, designed to entice smaller companies. They might be in the life sciences field. They might be in a smaller banking regulatory field where the business, you don't need an MD&A, management's discussion and analysis, every quarter. You'd rather have management spend their time and resources on running the business, as opposed to once they go public, they're immediately doing Qs, and as soon as 1 Q is filed, they start work on the next one. So there will be some differences, but we have those differences today with foreign private issuers and domestic issuers. So I don't think it's going to create any problems.
All right. Jim, thanks for taking the time. Jim Maloney there, Director of the Division of Corporation Finance over at the SEC. When we come back, a conversation with Sheila Bair, the former FDIC chair and current senior fellow at the Center for Financial Stability. This is Bloomberg.
I believe that talent is equally distributed, but opportunity isn't. But education can give everybody the opportunities that they deserve to fulfil their potential. That's why I got involved in politics and why I got involved in the Labour Party.
In case you missed it on Bloomberg Surveillance.
There is no policy response that can stop this ascent in crude. None. And yes, you hear this 400 million barrel headline. Flow rate is what matters. You know, the maximum sustainable flow rate is 2 million barrels per day. So 400, that will take them 200 days to get that out.
What would you call this then? A PR campaign?
It's all they have. They're going to do whatever they can. But I think the key issue here, keep the hoarding down.
How much are we underpricing some of what needs to happen?
I don't think we know what can happen here. I like to say, get long, buckle your seatbelt, hang on for the ride.